Hey guys, I just wanted to jump in for a second and let you know a little bit about today's live stream sponsor, DNA Funded. DNA Funded has very generous profit sharing up to 90% and 3 different unique challenge types. For those looking to get funded, they also have speedy payouts, unlimited trading days on the first and second phase of their challenges, a very wide list of different things you can trade with over 800 different assets tradable, and maybe the most important component, a very experienced team behind the whole operation. So if you're interested in learning more about DNA Funded, click the link, check it out, see if it's right for you, and make sure to do your own due diligence to see if what they have to offer fits your trading style. For 20% off, you can use code A1T20. Again, that will be 20% off any of their challenges you'd like to check out. Thank you again to DNA Funded for sponsoring today's live stream. Now back to the show. All right, good morning, everyone. Welcome back to another live stream. Hope everyone's doing well. Hope you had a nice weekend. I had a great weekend. It was a nice, relaxing. Actually, it wasn't really like, it was a good mix. You know, I feel like my wife and I were speaking about this. We were talking about what makes a really good weekend. And our definition is a really good weekend is a weekend where you get a lot of things done, but you also like have a lot of fun and like hang out with people. And I felt like we kind of had a really good example of a weekend. We hung out with friends. We hung out by the pool this weekend, but then we also like we're moving stuff from our old office to the new office that we're in the process of moving our office. So we went and picked up some stuff on Saturday. So we did some moving. We cleaned our house. It's a good mix. I took a nap on Saturday. I love taking a good nap, but got a good nap on Saturday after doing all that. So it was a good weekend. I feel like well, if you guys had to put a percentage on a good weekend, what percentage is work and what percentage is chill? Like for me, I actually feel like a good weekend is maybe and when I say work, I'm talking about like any kind of work. Like it could be trading, back testing, it could be cleaning out your garage, it could be doing something productive versus being chill. For me, it's 50-50. Like the best weekends, I get a good mix of chilling out and getting things that I wanted to get done. Let me tell you a little bit of a confession. The worst weekends are when I just feel like I have a ton of plans that are all like formalities. Like, you know, just like, oh, I gotta go get my passport updated. Like just boring things I really don't want to do, but I have to do them, you know? Those are the most frustrating weekends. Or like when I have to like travel across town just to do some arbitrary, like, oh, that I like when I can kind of stay home and do like a 50-50 split, like hanging out with people, chilling out, and then the other half being like clean the garage, you know, clean up the yard. I did a bunch of yard work this weekend. It was great. Anyways, hope everybody had a nice weekend. I did very little work, I guess, this weekend. I did 2 videos, which is a lot less than I usually do on the weekend. Usually I do a lot of like A1 work, but this weekend I took it pretty easy. It was nice. Hey, Blank, good to see you, my friend. Thank you for being here. Hope everyone, like I said, is doing well. Hope you had a nice weekend. Good to see everybody in the chat. We have a lot of our regulars. Got Ball out in the chat. Good to see everyone. Alan, nice to see you. Yeah. So, all said and done, Russell's doing really well today. This trade I've got running is looking pretty sweet right now. I've trailed my stop. Actually, you know what? I have not technically trailed my stop. And I'm going to do that right now before I forget to do that. Hold on. Let me just pull this up. I need to trail my stop loss on this trade that I'm in. I did it on my own broker. Let me just do it on my trade mirroring spot. So I am trailing a stop on the Russell trade, specifically on the 4-hour chart, moving it up here to 2073. 2073. So I've got Russell. I'm just going to move this stop. Really nice push here. Market opened up and Russell's off to the races. I love to see this. Small cap companies doing pretty well. I think that's a little bit of the jobs report looking okay. Inflation's in a decent spot. I think rate cuts are coming, and I think that that sets up nicely for the Russell. Small caps to me are underrated at this time, and it's a part of the market that I'm looking to play catch up on. Let me just, while I'm doing this, I'm going to need to update my positions inside of the group. So let me just update this really quick. By the way, if you are interested in getting trade notifications anytime I take a position, you can get notified. I'm showing you right now my side of things, how I do these. So I have this Russell trade that I've just moved the stop loss on this one. Love this. Nice follow through push here to start out the week. And so what I've done here is I've now moved my stop loss higher into profit. So stop loss has been trailed. I'm going to take a screen capture of this and share this with our members in the Discord. So ignore these bad numbers. Those are not correct. Okay. All right. So trailing stops just behind market structure / past resistance, now turned support. Okay. Nice follow through after strong jobs data on Friday. Okay, so I'm going to just update that to members. So if you are in the group right now, this update just went out. We are trailing stops further on Russell, locking in some more gains on this one. Yeah, Russell's been a really good trade for me. It's US 2000 for CFD brokers, IWM if you're trading the ETF like I am, RTY if you're trading the futures. So why the Russell? Why am I not trading like S&P? Well, first of all, the one of the simplest reasons is because I think that the Russell has a lot of room to catch up. 2.2% until we get to the all-time highs for the S&P 500. The Russell, guys, even with this rally today, we are still 15% from that all-time high. There's one more thing I need to do on the side here is I need to update our trade tracker. Let me just do this really quick. If I don't do it while this is usually why I don't actually update my trades on stream, is because I have to kind of pause everything on the stream in order to go through my process of updating members within the group, which is nice because I'm not a day trader, so I don't have to be like second by second updating. It's not super time sensitive, but let me just fix this really quick or just update this. So the stop loss on IWM is 206.64. So we have a stop loss now trailed into. All right. So let me see if that will update for us. So for members who have the trade tracker, you can just pull this up and it should be updated here. Let's see. There it is. Boom. Stops trailed into profit. Sitting on a 5+% gain on the Russell. So good start to the week. Also, NZDJPY, another position that I'm in, just went into profit. And I'm still sitting in that CAD Swiss trade. It has been the most boring small drawdown that I've ever sat through for this long. I mean, the CAD Swiss, I'm in 2 positions on CAD Swiss. You can see one, I'm floating a minus 2.6% move in CAD Swiss. The first trade I'm in is a minus 0.2%. This trade tracker, by the way, is available to members inside of the Discord. If you are a member of our group, you can comment or message in on our website and ask for access to this if you're a VIP member. And if you're not a VIP member, now is a great time to join. I promise that wasn't meant to be a sales pitch lineup, but it kind of worked out for it. So if you're interested in joining the VIP group, it's currently 45% off. It's the biggest discount that we do all year long. If you'd like some information about joining our VIP Discord, click the link being dropped here in the chat. You can send us a message letting us know that you would like to join that Discord. And like I said earlier, you'll get notified any trade updates that I take, on a real live broker account, no nonsense. I share my performance updates every few months on my channel. I do my best to offer a service that is transparent, real trading, no BS, no holy grails, no false advertising, nothing of that sort. If you're interested in joining a serious and real trading group, get 45% off. The sale is happening right now. It's the biggest discount that we offer all year long on VIP memberships. So there you go. Jordy, please follow the instructions on the Edge Finder. If you have a copy of the Edge Finder and you have the old version, we just updated to a new system or a new link. You'll just need to follow the instructions on the Edge Finder in order to get access to the new link. Taking a look at the dollar index, we are still, I was interested to see if we would get any kind of over the weekend news in terms of trade deals. But, I think that time is working against the dollar in some ways here. What I mean by that is that you have trade deals that are supposed to be happening, right? There's this 90-day pause. We got the 90-day pause, and trade deals just don't seem to be happening. I really do want to talk about gold, because there's some stuff with this whole Elon and Trump, right? Somebody asked me, does that really impact the markets all that much? And the answer to me is actually yes. It's actually a really big deal because, I don't know where you guys sit on this. Of course, it's a very controversial subject, as everything these days is. But the frustration that Elon Musk had, in some ways, calls into question the national debt. That is really what it all is centered around. Elon believes strongly, whether you believe in his approach or not, clearly him and many others is a bipartisan issue, that the U.S. national debt is simply unsustainable, and could lead to a sovereign debt crisis. You want to talk about an actual threat to America? There it is, right? National debt blowing up would be a massive, massive problem. And so Elon Musk expressed a lot of frustration last week with Trump and the bill that they're trying to pass and all this, because they, look, this is nothing new. And although Elon Musk has plenty of criticism, this has been a rotating wheel. Democrat, Republican, doesn't matter. The story remains the same. Politicians claim they're going to cost savings, they're going to cut spending, but then the whole system is designed for more government spending all the time, because all the elected officials, many of their sponsors, benefit tremendously from massive government spending. And if they don't vote on those things that keep spending more and more money, they get kicked out of Congress. It's a broken system, and this is why, part of the reason why I am sort of always subtly in the bullish camp for gold, because gold in some ways offers some safety from a debt crisis blow up. Ray Dalio, the famous investor, Bridgewater Associates, he managed a huge hedge fund, super successful. Dude, I've listened to him talk about gold in the past as just having a bit of it in your portfolio. I think I've seen him say like 5 or 10%. I can't remember exactly, but having the all-weather portfolio, I think, has some allocation to gold just sitting passively. I can't remember if it's 5 or 10% of the portfolio. The famous Ray Dalio all-weather portfolio is the idea that you can have a portfolio that should do relatively okay in good times, bad times, horrendous times, and amazing times. You're not going to do, it's underperformed over the long term, but if you're looking for something that's relatively safe, right? The classic Ray Dalio all-weather portfolio has some allocation to gold. And the idea is, like, if you get some sort of debt blow up, gold would probably skyrocket, right? And so there's this idea that having some exposure to gold could be a very strong catalyst or a very strong hedge in the form of a diversified asset that actually would do well in a debt blow up. So anyways, when it comes to gold, I am always sort of in the bullish camp, but there are times where I'm trading it more aggressively or there's times where I'm sitting out. Right now, gold is getting a +6 on the Edge Finder. Specifically, I wanted to look at the commitment of traders data to see what institutions are doing with gold. And what we can see here is that when we look at the gold weekly filing, there was a decrease in short contracts and an increase in longs. So institutions bought gold in the past week. According to the Edge Finder's commitment of traders data, still puts us at 81% of positioning is on the long side for institutions. Very interesting to track that. We can also take a look at the COT data history and pull up gold here for a second. And what we see here is that the overall net positioning or open interest in gold has been declining, like less positions, both long and short, I guess. But noticeably, the percentage of longs ticked up here recently. We've seen a little bit of net buying. This yellow line has been kind of in decline for a little bit, but for the first time in a while, we now actually see some net accumulation on gold when looking at institutions. So I do like the idea of potentially getting long gold. Specifically, I like it a little bit more if we get a dip down into this 3,200 to 3,250 range. I'd be interested in taking a stab, possibly long there, if the Edge Finder still gives me a bullish confirmation. We have CPI this week. Let me just take a quick look at the CPI data and how that's currently impacting gold. So if I look at inflation for gold, yeah, so we had cooling inflation last time around. That was very bullish for gold. So we do stand to lose more points than we can gain here on inflation, if you think about it, right? Because the Edge Finder for inflation on gold goes -2 possible score to plus. Actually, I think it goes, I have to double check, but I believe it goes 2 to -2, or it's -2 to +3. I think there's a one unique scenario for gold where it's possible to get a +3 score. Anyways, inflation this week is big for gold. If we're going to continue to see gold upside, you really want to see inflation continue to come down. So we get inflation report, I believe, on Wednesday. So it is a big week on that regard. We've seen inflation come down, go sideways, come down, start to rise, and now has been falling. We've had 3 consecutive better than expected CPI reports here, guys. But with today's number, or I'm sorry, with this week's number, let's just take a quick look and see what are we expecting for CPI this week. And I think it's Wednesday. Yeah. So Wednesday, we are actually expecting a tick up in inflation. You can see the expectation here is 2.5%. So the market is actually expecting this number to go higher, up to 2.5%. So we'll see if that happens. But what if you get, for example, another 2.3% reading? That would show inflation is really quite soft and would probably suggest that the Fed could cut rates. So we'll have to keep a close eye on inflation this week. That's going to be a big market mover for everything. Stocks want to see falling inflation. Gold wants to see falling inflation. Silver, I don't know if you guys saw this. Silver is an absolute rocket ship right now, breaking through these highs around $35 an ounce. Looks like silver's the new gold right now. Gold is kind of been chopping around, doing a whole lot of nothing the last 2 months. Meanwhile, silver is actually moving with some momentum here. In fact, let me just take a look at silver on the top setups page. Are we getting anything for silver? Nope. Silver's getting a neutral reading. But I am going to keep an eye on that one. Current setups that look interesting: CAD yen, euro dollar. I want to look at those currency pairs here for a second. Let's also just take a look. Check this out. I've been working on this little tool here. Some of you guys might like this. It's a bit of a currency heat map for your trading view. Been programming this the last few days. So check this out. If we take a look at the strength of the dollar, and this is based on a daily chart perspective, but with the currency strength table, which is not yet available, but will be available soon on the website. You can change it to whatever time frame you want. I just leave it on daily chart personally, but you can change some settings around if you want. But anyways, USD CAD, for example, trending just straight up to the downside. You have dollar Swiss mostly trending lower on most of our moving averages. Dollar yen is actually just the only currency right now kind of weak against the dollar has actually been the Japanese yen the last few days. Euro dollar and pound dollar looking pretty strong on our 20, 50, and 200-day moving average. Gold looking relatively strong, except for some of our lowest, the 5 moving average. Australian dollar and Kiwi dollar just all green. And what I find is like when you get an all green or an all red, those charts are moving, right? Those are like high momentum chart movers. So if we were to pull up, for example, here, let's go Kiwi dollar, right? If we pull up the Kiwi dollar, you can see this chart is moving and grooving. And in fact, it's actually sitting right here at a interesting spot. I talked about this on my Sunday video. I didn't like the way that we kind of just passed through this area and then just whipped back into it. But if you get some pull back into this area, I don't think I have a strong enough reading on this one to take a trade. Actually, I do have a Kiwi dollar and Aussie dollar bullish setup. Both are getting +5 on the Edge Finder, which is really interesting. I'll have to keep an eye on that. Let me look at the Australian dollar also while we're at this. Nope. See, this chart looks a little choppy with a couple wicks on top. I'm not super loving the price action here, but I'm really interested. If you get like this kind of move, a more decisive breakout, I really like the idea of getting long these currency pairs. Pretty cool. Pretty cool price action here. Pound dollar is also one that I'm looking for pullbacks on. Euro dollar. For me on this one, I would either need break and retest on euro or a pullback into the bottom of this range. 1.11 would look interesting for me for a possible long side continuation. But I am pretty confidently bearish the dollar at this time, which makes me bullish on gold, bullish on euro, bullish pound. So also still bullish on the indices, although not looking to like add a bunch of trades on the indices. So if I pull up, for example, Russell, I'm in this trade. I've trailed my stop. I trailed it earlier in the stream. For those who are just arriving to the show, I just trailed my stop loss. If you're a VIP member with us, like I said earlier, update has been shared inside of the Discord. So if you'd like to keep up with those trades that I'm sharing in there, they are in there now. But if I'm looking at like NASDAQ, for example, I mean, this chart looks amazing. I think it's headed higher, but that doesn't mean I'm going to like buy it here, right? So like I'm already in the Russell pullback. That was my pick of the group, and I'm glad that I did. It's up quite a bit here today. It's up almost 1%. NASDAQ is flat on the day. Same with the Dow and the S&P. But when I look at these things, I say, okay, I'm bullish, but I can't just buy them at the current levels. I have to still wait for the chart to come to me. So I like the NASDAQ. I like the S&P 500. Last week I spoke with Marco, who comes on the show pretty often. Him and I were talking about the indices, just about how, the indices have not given a whole lot of pullbacks. Like this Russell trade, I barely caught it. Like it shot lower, and then like I got it on the rebound, but I still felt like I was, it was so brief. The indices are so strong right now in terms of their price action. It's been very difficult to catch any sort of pullbacks. So I caught this one. And so I'm in the Russell, but the other ones have just not even given me much to work with. You do have the DAX. This is another one. I don't know if this is still bullish on is it? Nope. Back to neutral for the DAX. Possibly some economic data. I'm seeing PMIs came in soft a little bit for Europe last week. So that might have hurt the DAX trade for me a little bit. But if we pull back and we get some better economic data out of Europe, DAX might be interesting to me. So I do love the technicals on the DAX. The DAX looks so strong. If we took German 40 and crossed it against SPX500 really quick, you can see here, this is the German DAX versus the US S&P 500. And you can see pretty much all year, DAX has been dominating, right? The DAX is kicking butt, looking really, really strong. So back to S&P 500, we had a really nice bullish week last week. Like I said, I think we are headed back to those all-time highs. But the only way I would take trades on the indices at this time would be pullbacks. So I'm sitting in the Russell trade, waiting on the rest. Dollar index, we talked about it briefly earlier. We are sitting at support. We had a good NFP report, which I think saved the fallout here, right? We were looking like we may plunge lower on the dollar, but then that NFP report came in relatively stable, right? So you had on the jobs report last week, just a quick recap, NFP did beat. It didn't beat by a lot though. And if you have the Edge Finder, I sometimes forget. I was thinking about this on the drive into work today. I thought to myself, dang, I didn't even pull up the monthly change, like the actual minus forecast data point chart that we built. And it's so useful because it shows like the significance of the NFP report that we got. I thought about this too. I thought about maybe making another variation for the NFP chart that's actually just revisions, right? Because revisions are a drama source, because notice something here that's kind of interesting, guys. They revised lower the last 4 jobs reports. So for those of you guys who are newer to the NFP report, let me just show you something of substance here. The revisions line is in yellow. So revisions is what they do each month. When they report the jobs print, they also revise the previous month before that's number. Sometimes they revise it higher. Sometimes they revise it lower. But what I wanted to show you is that if we look at the yellow line here versus the blue column, which is the number of jobs added, notice how for the last 4 reported numbers, the revision line has revised the previous month's numbers lower, right? So on May 2nd, the NFP report came in at 177,000 jobs. On June 6th, they revised that number from 177,000 down to 147,000. That's no joke. It's a pretty significant cut in jobs data, right? So we can't ignore that. Revisions have been consistently lowering jobs. Hold on, I'm gonna sneeze. Excuse me. So in recent times, we've had consistent revisions lower on the jobs print. And I think that's important that we acknowledge that because revisions are still, they're corrections. So if they're correcting it down lower each month, it is showing a little bit more weakness in the labor market than people think. This is just another reason why I think that the Fed is likely to cut interest rates this year. We also had ADP numbers, which came in abysmal. Private payroll sector missed massively. I think the low end of expectations for this number this past week was 70,000. And so the low end of expectations was 70,000 and we got 37. Right? So ADP numbers were not so good. And so this to me, it doesn't surprise me that the dollar index is not, rebounding massively, because let's go back to our NFP chart. And this is the importance, right? The importance of actually understanding your macro, understanding the fundamentals here. Some people were asking, why didn't the dollar make a bigger move? Like, why was there not a big reaction? Well, magnitude really matters. We beat the jobs print on Friday. We did beat the number, but look at the magnitude that we beat it. Was it a big beat? No. These are big beats or big misses. These are beats of magnitude that really substantially matter. But when you look at a 13,000 beat, that's not a very impressive or sizable beat. So it is important that we understand that. It is very, very important that we understand the actual data points. How significant are they in terms of their impact on the chart? So dollar index, yeah, did it have a bit of a bounce on Friday? Sure. But the magnitude of the beat wasn't. If it was a really good NFP report, you would have seen this, right? If you had seen a massive hiring spree, then that's what the dollar would have done. But we didn't quite get that. So was it a bad jobs print? No. But was it a really good one? Nah, also no, right? So in terms of currencies, if we're looking at like euro, if we're looking like pound, I still do think that a lot of our economic data suggests some outperformance from other places. Let me show you, because we have a chart for that. That's what we do here on the channel. We show charts to back our ideas behind why we want to be long or short something. It's a simple concept that most traders do not employ. Most traders draw pretty pictures on a technical chart and say, that's why I think it's going to go up or down. On this channel, we look at real stats impacting the global demand for currencies, commodities, indices, company performances. We look at that stuff. We uncover why a market should go up or down, not just, well, the chart's looking pretty and it's going up, I should get long, right? We look more than that. I think we should. I think we should use all the available data that we can to formulate an intelligent decision on where we think markets are going based on the data. If you feel the same and you are new to the show today, consider subscribing and consider hitting the thumbs up button. We do this every day of the week, and we do our best to bring on various guests who do the same. So when we look at this economic surprise meter, by the way, is anybody new to the stream? If you're new to the stream, type me in the chat. Just let us know that you're a new stream viewer. I'm glad that you're here. I hope that what I'm sharing is insightful or helping you in some way. And I greatly appreciate you being here. How about the unicorn head, shoulders, knees, and toes pattern, Nick? Wow, you are a funny guy. Yusuf's first time here. Good as it. Wow, we have some new people here. Thank you for being here. So just FX Shadow, you're a liar. I've seen your name. 24/7 betterment. I some of you guys I recognize you, so you can't pull that on me. But if you are actually new, thank you for being here. We do this Monday through Friday. We talk markets. I share trade ideas, things that I'm in. I share my my thoughts on economic data as well as technical charts. What you're looking at here is the economic surprise meter chart on the Edge Finder. It helps us look at economic data from a broad perspective. So if we look at this table, right, this is a lot of data all at once, which I love this page, and a lot of people do as well who use our products. We can look at like manufacturing PMIs and services PMIs. We can look at CPI, which comes out this week, by the way, really big report. We can look at all this stuff line by line, and that's great. Or we can just say, okay, all that said, let's let software interpret the net kind of, is this bullish, is this bearish for the currency? And what we can see here is the underlying economic surprise meter. So countries that are outperforming expectations the most right now: Japan, Canada, New Zealand, UK. Countries that are missing expectations: the US, the Swiss franc. Now, does that mean that the US is the weakest economy of this list? No. It's all relative to forecasts, right? It's like if you're talking about, I don't know, pick your favorite sports team or sports player and say, how good are they going to do in the upcoming game? Well, if they're the best of the best, you expect them to do incredible. What if they have an off day? Does it make them the worst player ever? No. It's all about expectations in markets versus fulfillment or missing it. And so right now, the US economy is by far the strongest economy out there, right? It's central to everything, but it's still relatively to expectations missing recently across a lot of its metrics. For example, services PMIs out of the United States really missed expectations here. We went into contraction territory. We're a services-based economy, so this is a big chunk of our economy, and we had a big miss there. So, if you're looking at the US economy as a source to say, should I be bullish or bearish on the US dollar? Right now, my system, the Edge Finder, which looks at all of the major data points that the Fed uses, suggests more bearishness for the dollar and has been doing that for a little bit here. Bulent says, no country can miss better than my country, Turkey. Bulent, I really want to go to Turkey someday. I have one of my best friends is Turkish, and we've talked about making a trip to Turkey happen someday. So I would absolutely love to go. It looks beautiful. I want to go to a beach in Turkey. I feel like that'd be so cool. Markets just opened up here for the US. S&P 500, slightly lower here. This is your 5-minute chart. So we'll see if it causes if we get any major moves one way or the other today. Go to Bodrum. I'm not sure if I said that correctly. Yeah, I would love to go to Turkey. Half Turkish. That's awesome. Anyways, yeah, so overall, the jobs report last week was good, not great. And I think that's all the market needed, because the market was kind of expecting. The market has actually been looking at the economy and saying this thing's going to crack. Like, tariffs are going to ruin this. And you can see that in the sentiment, right? We've talked about this a lot. We've done a lot of economic data this morning. Let's take a look at some market sentiment really quick. Investor sentiment survey, still very bearish. Take a look at this. 41.4% of respondents saying they feel bearish about the outlook of the economy, or of the stock market specifically, right? And they plan of coming to Ireland. I was there a few years ago, and it was absolutely beautiful. I ran a marathon in Ireland. Yeah, not a lot of people think I can run marathons, but, I ran one in Ireland, in Cork, Ireland. It was the trip of a lifetime. My wife has always wanted to run a marathon. So have I always wanted to run a marathon? That's besides the point. But we ran one together because my wife really wanted to run a marathon. Yeah, but anyways, sentiment here still bearish, man. And that is something to think about. Is, when you see the crowd sentiment still very negative on this market, to me, what that suggests is that we may still have upside as people capitulate. We hit 62% of respondents saying they feel bearish on this market during the peak, ugliness, back in March and April, right? People were absolutely selling out of their portfolios, thinking I'm going to be able to buy this thing way back lower. The administration's going to run us into the ground, and I don't say that to be tongue in cheek to people who don't like the president, but to be completely fair, people said the exact same things under Biden. I was listening to a podcast this morning, just somebody talking about the whole Elon thing, and he was pointing out about how if this person, Peter Schiff, anybody know Peter Schiff? I listen to Peter Schiff sometimes when I want to feel bullish about gold, I'll listen to Peter Schiff. But, he was talking about how he thinks, the two political parties have actually kind of converged rather than diverged, right? So he thinks like they're both extremists, but almost in like similar fashions. Anyways, the political landscape in America is crazy. Clearly, we saw just that insane fallout with Elon and Trump last week. And yeah, I mean, it's a crazy concept. I talked earlier just about how, to me, the long-term bull case for gold has always sort of been the idea of the national debt, and how the whole system is designed to keep spending and spending and spending. And you know what the problem is with the whole national debt thing? People say, they've been saying that for years. Well, that's true. But, well, you know what else we've also had for years? An economy that just won't quit. GDP growth in the United States is and has been very strong for quite some time. Can I go back further on this? How far back can I go on the Edge Finder for GDP data? Oh, heck yes. We got data. We got data, ladies and gentlemen. Okay, so the US economy has been like nothing short of resilient. Too many comments. Nick can't keep up. Never sees mine. If you have a question specifically about the markets, let me just double check that we have time for this, because we might not today. I might have run too long. Well, Ivan might join for some questions. If you guys have a question about something and you feel that it would add value to the stream and would like to ask that question, To Robert's point, the chat moves like this, so I sometimes miss people's question. We'll do questions in just a second. If you have a question for the stream that you think would be adding to the conversation, maybe we could drop the link here. James, if you have that link for questions, there it is. Boom. Thank you. If you guys have a question for the stream, drop it right here. And maybe in a second, Ivan and I will answer some questions that you guys have. So part of the thing with the national debt is that throughout the national debt, if you have debt, right? Let's say you're lending me money, right? I ask you, hey, can I borrow some money? And you're the bank and I'm the borrower. You're going to say, well, what's your income? Because I don't want to lend you money if you can't pay me back. Well, then if I showed you, hey, I'm a lawyer and I make this much money and I'm doing pretty good, I can pay you back. You're going to say, okay, this is a pretty credible loan. Here's the money. And then I go away and I pay you back over time. But what if I came to you and I said, hey, I'd like to borrow some money. And you said, what's your employment? What's your income? And I said, oh, I don't have one. I just got laid off. Then you're not getting a loan. Well, think about that on the country level. The US growth has been really good. So to the credit of, the US economy, it's been a really strong, consistent outperformance in recent years. That's how we survived 2022 without a much bigger crash. People were terrified. Oh my gosh, Biden inflation's going to ruin us, all this and that, yada, yada, yada. What happened? US economy continued to churn and burn, and it in a good way, churn and burn in a good way. Not the best wording, but labor rates, unemployment stayed low, right? Strong employment, strong growth pushed us through that period of inflation in an amazing fashion. And we've consistently had a strong economy since then. That's all good until it's not. And that's where you have to be worried about the national debt, because what if someday these numbers start to materially worsen? What if we strap on so much debt to the country that it cripples us, and instead of stimulating the economy and finding ways to give tax breaks and things like that, we just have to spend all of our taxable money on just administering our debt? The problem is that cuts into GDP and makes our credit status less attractive to investors. We saw Moody's downgrade the United States. What if we get a rapid continuation of downgrades, right? I know this is doom and gloom. And I don't necessarily think that, I think the U.S. economy looks really strong given everything we've thrown at it, right? Inflation, geopolitical conflicts on all sides, and, a power struggle between the different political parties and all this stuff. I'd say despite all that, the U.S. economy has been really impressive. If it was not super impressive, then the market is smart enough, I believe, to have already said, we're not lending you money. If sometimes people are like, no, the US economy, it's all a sham. It's actually way worse. Well, then why isn't the 10-year at 6%, 7%, 8%? If it's really that bad under the hood and everyone is getting deceived, I trust the intelligence of markets enough to say, if it was really bad, if they were faking all the numbers and this was actually way worse than expected, okay, then why are people still lending the U.S. government money at 4.5%? Shouldn't they be lending it at 8, 10% if it was really that bad? You see what I'm saying? So that's where I think you can go down that rabbit hole of thinking, oh, they're fudging all the numbers and none of it's real. Okay, then who's the suckers that are lending money to the government at these levels? And I'll tell you what, before you think the bond market is stupid, check yourself, because it's called what the Fed's going to do before pretty consistently in recent years. It's actually, bond market's pretty dang smart. So in my view, part of the reason the bond market is not skyrocketing is because there is this credibility that, the US economy looks relatively strong for now. So I don't think that, we need to rush and go all in on gold and run for the hills and stock up on cans of soup. I'm not that, I don't believe that is the correct move either. But it is worth keeping an eye on this, keeping an eye on GDP numbers, watching the stats, watching the data, right? So it is just my thoughts on that. If you have questions and you dropped them in the chat, I'm going to now, or not in the chat, in our form, I'm going to pull up some of those now. Maybe we can just take a look. James, if you could just double check just to make sure we are clean on that. I think we are. I'm just going to do our first question. Our first question of the day. If you submitted a form, if you didn't, maybe we'll drop that link one more time. It'll be in the chat here. Bulent, I hear you on that. It's common practice for strong economies when they're in trouble to go into some sort of war event. Who knows, man? Maybe so. Let's hope not. Steven's been trading for 3+ years. Their question of the day here is, I've been using the Edge Finder for 2 years ago, and I'm not able to log into the new update. All right, Steven, great question. But if you do have, if you need further help on that, send us a message on our website, a1trading.com, or just follow the instructions on your Edge Finder. If you're not able to log in, we put specific instructions for how you can regain your access to the new link for people just like you. We've had many people, wondering the same. So shoot us a message on our website. Next question is from Robert. They've been trading for 3+ years. Primary goal right now is to become a funded trader. I'd like to know what has been going on recently fundamentally with markets. Missed a lot for weeks. Thank you. What's been going on fundamentally? You can always keep an eye on with the Edge Finder because, again, it's all in the data. So if we take a look at the economic heat map for the U.S., you can see pretty consistently recently we've had pretty negative U.S. economic data come in. PMIs were weak. Services and manufacturing were both weaker than expected. Jobless claims last week were weak, right? So you can, just take time. If you're an Edge Finder user, take some time out of your day or out of your week. Some people use the Edge Finder once a week. Or even place trades once a week. I have traders in our communities that are like once a week type traders where they come on Sunday and they take a look at everything and they place their trades on Monday and then they are done for the week. There are people who are not necessarily scalpers or day traders. There's, some normal sane people out there that work full-time jobs and trading is a side income or a side hustle for them. And they're just trading, once or twice a week. And they just check in on the economic heat map to get an idea of what the latest data points come in, place their trades, place their limit orders, whatever they do, and they move on. I think it's a great approach. I honestly think that if people were doing less in terms of actual placing trades, they'd probably be in a better spot. Most people would benefit from doing less. Less truly is more when it comes to trading. Matt is our next question. They've been trading for less than 1 year. Primary goal right now is to find a profitable trading strategy. Ben Graham's The Intelligent Investor. Has it influenced your trading style? How so? No. I've definitely seen bits and pieces all over social media, but I've never actually read that book. If it helps you, if you're a reader, then by all means go for it. But I'm not a big reader. I never really have been. I've learned a lot of the stuff just from, I like to listen to a lot of stuff. I'm big, listen to audio and all that sort of stuff. Yep. Okay. Let me just refresh this really quick. See if we have, we got a couple more questions here. So what we'll do now is I'm going to just quickly transition to bring in Ivan to the conversation. And then maybe he can help me to answer some of these remaining questions. So stay tuned. Ivan's coming in just after this.
Attention A1 Trading Show fans. If you're interested in getting free access to the Edge Finder or our premium trade alerts, listen up. For a limited time, our show's partnered broker 8cap is giving out free access to our products when you sign up for a new trading account with them. If you already have a broker, you may want to consider switching to 8cap because of their low trading costs, a wide range of trading assets, and their amazing customer support. If you'd like to get access to our software and Discord server for free, click the link being dropped in the chat right now and ask one of our team members for more information. Don't miss your chance for free products and an award-winning broker. Now, back to the A1 Trading Show.
All right, and we're back. Give me just a second, Ivan. I'll show up here. How's it going, Ivan?
It's going great.
Good to have you back on the show. I was just in the middle of answering some questions. You want to help me answer a few of them?
Yeah, I can answer some questions.
All right, let's do it. Okay, so let's see. We just did Okay, we've got a couple questions here. All right, next question's from Dragon, kind of a cool name. Been trading 1 to 3 years. Primary goal right now is other, so we don't know what their primary goal is. Hi, Nick. I wanted to ask your bias on silver since it's been a monster these last few days. My bias is bullish, and I'm waiting for a retracement this week to get a long entry. Ivan, what are your thoughts on metals? Silver, huge breakout here. What are your thoughts on this?
I saw people calling it. I didn't call it, so I'll be like, "Oh, great." Well, I said, I think a couple of times now that I am dollar bullish, so I think gold should fall this week. So great.
So now you're dollar bullish. You flipped.
Yeah.
NFP report did it for you.
Yeah, seasonality. No, not really. Yeah. GDP.
Okay. Yeah. So you're thinking metals might have more downside to come in this week then, specifically gold and silver, clearly the stronger of the two. Maybe gold will have a bit more of a pullback. I hope it does. I'd be a buyer if we can get down to like 3,200 or so, but we'll have to see. Let me I kind of agree when it comes to silver. I can't touch it at these levels. The person asked about a possible retracement. I'd be interested in silver if it does get a retracement. This is such a significant breakout. I'd probably be looking for longs if we got like a 3450 retest, but can't do anything with it up here. Our next question here is from Loris. They've been trading for less than 1 year. Primary goal right now is to become a funded trader. Have you ever considered compiling a video of the best and most useful questions? It would be beneficial and useful. There's so many questions to ask. There are some great ones. Ivan, do you have any? Here's a fun thought exercise. Do you have what are like the best types of questions that you get? Like what kind of things do you think new traders should be asking and should be thinking about?
If I take one of the members and look into what this person is struggling with is chart time. Getting to understand price, not necessarily action, but movement and the ability and the velocity of how things can move, I think is a great, at least, starting point, because what drags you into a thing is that it moves fast, quickly in a direction. You think, oh, great, this is going to be the holy grail. You enter at the peak, it goes down again, and you lost everything, and you wonder what you did do wrong. So for me, it's more of, getting to calm down your nerves and your excitement. Probably the first thing to do.
Yeah, that's a good point. Is, the excitement too goes a long way with what like reasonable expectations are for traders. I feel like that's a very, very common misstep to I don't think new traders' fault. When you go on social media and it's people who are talking about, how they can turn $100 into $1,000 with the markets, and like that's what you see all over the social media world. I think lowering your expectations from trading is like an amazing step that people skip, right? They have these super high expectations for what realistic trading returns are. That gets them into a ton of trouble. And they think that, I thought this too when I first got started trading. I thought, profitable traders are people who just can predict the market all the time, and they're just always, on the right side of moves. And little did I know until years later that that's not how profitable traders function. Profitable traders simply make more than they lose. They're right sometimes, they're wrong sometimes. Over the long term, their equity grinds higher. It doesn't sprint higher, right? What I mean by that is a lot of times people think, like, let's say this is your trading account. New traders think that profitable traders, like, this is what their account looks like. That's what they think it looks like. When in reality, what I've found in my own journey and in all the people that I've interviewed, successful traders out there, their equity curve looks more like this, where are they making more than they're losing? Yes. But it looks like this. It's not, and it's not a straight line. And even if you drew a straight line, it's way flatter than you think it is, right? So great players, they look like the green line. on an average overall basis, they don't look like the yellow line. This is a false impression of what profitable trading looks like. Profitable trading is a very slight edge applied over many, many trades to make more than you lose. And that's it. So just some food for thought. Okay. Glenn is our
Just
next
say
question.
well laugh.
Go ahead.
I'm sorry. Laura says he's able to turn $1,000 into $0 in 3 days, no problem.
Hey, Loris, that's talent right there. That's if you can predictably do that, all you got to do is just flip everything you're doing, and then you'll be a bajillionaire.
Yeah.
Anyways, Glenn is our next one. They've been trading for 3+ years. We saw gold and equities pushing higher together as opposed to their usual inverted price correlation in Trump's first term, and due to a host of reasons like the baseline uncertainty Trump brings to the table. And now, since he took office in January, we are seeing a very similar situation. What are your thoughts on this, Nick? So, Glenn, interesting concept, but I will respectfully actually reject your thought that gold and indices are inversely correlated. In fact, gold and indices typically are more correlated than inversely correlated. They actually tend to move. What you're probably thinking more of is actually the dollar and indices have, even then there's not like strong correlation. Just because the indices go up does not mean gold has to go down, or gold. Like maybe you're thinking of a specific time in history where there was an inverse correlation, but we can actually look at this, right? So if we take a look at SPX really quick, and we just we do a comparison of XAU USD and apply this, what you'll see here is that the correlation coefficient here, I'm just going to do an area chart. Check this out. So, this idea that gold moves up, stocks move down, and vice versa doesn't really hold up very well when you actually apply the data to it. You can see it's all over the place. There is no decisive correlation. There are periods of time where they move inversely. But again, like what I was just saying, most of the time, there's actually more of a positive correlation between stocks and gold than the opposite. What are your thoughts on this, Ivan?
There is a Norwegian saying, comparing apples and pears. I feel like this is apples and pears situation. Because I would argue that what drives gold doesn't necessarily drive S&P or NASDAQ. And what drives S&P can drive gold in the same direction, but it's not always. So you have to look into what drives S&P more than anything else. It's the US economy, how the businesses are doing, and most likely the top 7 of the companies doing, and the US monetary policy and also governance. But when it comes to gold, you also have other in addition to that, you have also the risk of the global downturn or greater improvements. You have demand for physical gold during certain times of the year, and now because of China doing so poorly economically, they have bought gold instead of having their own stocks. So there's a bit of different mix to why each of them drives, in this case, higher.
That's a great way of putting it too, Ivan, because like basically, that correlation, it goes in and out based on what you're saying, based on like what's happening, right? So if the Fed is cutting interest rates, is that good or bad for gold? It's good for gold. Is that good or bad for stocks? It's also good for stocks, right? So the Fed, you have to look at the Fed. You have to look at the economy, as you've pointed out. You have to look at central banks. You have to look at geopolitical events, right? I think it's, markets, while they do often rhyme, they never exactly repeat. And by being a fundamentalist, by being a macro trader, you're studying these things and thinking through how the current environment, which has never been the exact same in history, right? There's never an exact copy. You have to kind of take every little piece that moves markets and try and align everything and say which markets look like they're the biggest beneficiaries of the current environment, which ones look like they're going to be the biggest losers in the current environment. So the idea that stocks up, gold down, and vice versa, I would leave that in the past. That's a bad, you hear these things all the time. Ignore them, right? Study them yourself before you think, oh, if the dollar goes up, stocks have to go down. Well, go test it. We just did a really quick example. Pull up your correlation coefficient and check what you just said to make sure what you said is not ignorant to the reality of the market. So it's not, I'm not, trying to be harsh to this person who asked that question. It's a great question. But consider, like Ivan suggested, looking at the individual components that impact your charts that you're watching. Don't just do a blanket statement of, oh, well, gold and stocks should move inverse to each other.
It also comes down to dollar index as well sometimes, and they say that they should be inversely correlated to the stock market. It's not necessarily. The same thing with CAD and oil. It's not necessarily, and I think it's just 30% of it correlated. So 70% it's not. So it's more of, as I've always said, and I'm always going to say, what drives the market. What is the driver? And each currency and each asset and each class has different drivers, depending on how they are supposed to perform in a portfolio, and that should be your leading driver of whatever you're doing.
Right. Exactly. Love it. All right. Let's see if we have another question here. So let's see. All right. Ignacio, I apologize for butchering your name if I did. How long you've been trading? 1 to 3 years. Primary goal right now is other. Hey, Nick, how do you deal with possible gaps in trading ETFs? One of my worst fears is a gap so big that it destroys your accounts / profits. I trade CFDs, so gaps occur, but not so big as ETFs. Again, I'm feeling confrontational to everyone in the chat right now for no reason. So again, I will show you another example of why you are not safe anywhere in markets ever. Here is the Euro Swiss franc. If you think gaps do not exist in Forex or in CFDs or in commodities, or they exist everywhere, right? So I obviously I'm not actually annoyed with you, but I just want to point this out. Again, Euro Swiss moved in a matter of seconds, thousands of pips, 2,000 pips lower back in 2015. There was a whole story about why this happened. The Swiss National Bank said they were going to peg the currency at 1.2, and then they removed that, and the market completely tanked. Anyways, the reason I bring this up is because what's going to save you in environments like this? You could not possibly predict the time and scale to when a move like that is going to exist. Ivan and I have seen many examples on the live stream, even while we were streaming, for example, of like yen intervention a couple years ago. We saw that quite a bit. So how could you possibly prepare for those things? You can't, is the story. So what can you control in this situation? I'm trying to find a good example of like yen. Yeah, here's like, I think these were some moments where you had just spikes down lower on the dollar yen as the Bank of Japan intervened. What I want to share with you, though, is you can't control when these sorts of environments happen. You can't predict when that's going to happen. You can't predict freak events. What can you control? Your position sizing. So if your position sizing is at a point where it's too big and one of these freak events would blow you up, your position sizing is too big. Ivan, is there anything you'd add to freak moments like that? Like, obviously, we cannot know when those things are going to happen. They're going to happen. Trump's going to say something sometime, or President Xi is going to declare something, or things are going to happen that you cannot possibly predict. How do you account for them in your trading?
The dollar yen move. What you showed me. Showed the story. That one was possible to get out of. This move is about, what is it, 400 or something, 500 pips or so. That was, it slowly happened like a tick type situation. So you would get out at a reasonable price.
Yeah.
But if the Euro Swiss, that's 2,000 pips in a matter of milli micro, whatever that second was, you are going to get out at any sensible level at that 2,000 drop.
Mm-hmm.
There was a scandal in Norway about that, where people have been told by banks to just put your loan into Swiss franc. Mm-hmm. It's a positive carry trade for you. and all of a sudden they lost 30% of their loan value and needed to bring out, I don't know how depending on the loan, but they needed to bring out collateral of 30% of whatever they borrowed,
Right.
in a matter of hours. So it was a complete shock for them that that was even the possibility, and they were misguided by their financial advisors. So this you're able to get out of, but in general sense, if you take tariffs, if you take Xi saying something, Trump saying something, no, you're not going to save yourself. And that's the real risk of trading. That's what we're saying, that trading is not for everyone. This going into 300, 400 pips in loss just because you are wrong about the trade, that's not a risk, bro. The risk is when black swan event happens. And the reason why it's black swan, because you don't see it coming.
You know, I want everybody in the chat to think about something next time you're about to place a trade. Ask yourself, before you place the trade, what happens to me if the size that I just put on, if there's a freak event in the next 30 seconds after I place this trade? Am I going to be okay? And if the answer is no, your position size is far too big. Like I'm talking about, let's say that you are looking at the euro dollar and you want to, I don't know, let's say you want to go long. What happens if in the next 30 seconds, the market drops by 200 pips? Are you going to blow up? And some people would say, oh yeah, I would. Because what you actually realize is that in a move that happens that fast, your stop loss doesn't mean anything, right? So if you've ever experienced this, you will know the fear that comes with what I'm about to say. If you have a stop loss and it does not get immediately triggered, or like let's say that you're long and you have a stop loss here, right? And the market absolutely drops like a rock. Some announcement, EU, US tariff, whatever. I don't know. Something happens and it drops like this fast. What you may not realize as a new trader is that stop losses are not guaranteed. They are orders to close out of a position. They're just an order to your broker. But if there is no available liquidity at the price that you want, you get filled at the next available price, which could, for example, be down here. So you could theoretically take a 3 times the distance loss on a stop loss that you have. It is possible. Stop losses are not guaranteed. And so think about that whenever you're placing a trade. Would a triple my loss size kill me? And if yes, your position size is way too big. Right? It's a great way of thinking about it because position size can save you in a freak event like that. I've had things like that have worked in my favor and worked against me. But by keeping my size small enough, I don't get destroyed. Right. So I had that in August of last year. I had really big slippage on a Monday morning open, the yen carry trade unwind day. If many of you guys remember that, huge slippage for my account. I took a triple sized loss than what I was supposed to. And it absolutely sucked because it gave back a substantial portion of my gains for the prior several months. And it really, really was painful, but it didn't blow me up. I didn't get margin called off of that. I didn't have some meltdown in my trading portfolio because of that. My position sizing, even though, it's a good size, was still small relative to the account. Ivan, we got some good questions I got to get to here. Ruben asks, they've been trading for 1 to 3 years. What has been your most successful Forex pair over the years? Ivan, do you have a favorite currency pair that over the years you've done better than others with?
I wish I could say that with confidence. But I think euro yen is gonna be my because pound yen is a widowmaker, and also yen. Well, they're done, but pip wise, euro yen is my biggest one. I think.
Yeah, I think I'd be split between euro dollar and euro pound. Both of those currency pairs I've done pretty well with over the years, and I like euro pound because it is such a boring mover in terms of pip distance. And it works quite well for my dollar cost averaging approach. Okay, next question. This is a good one. I'm going to leave their name off because I think they would prefer it. They say, read this out loud or to yourself. Thanks in advance, Nick. I've lost over 40,000 pounds trying to trade with prop firms. I've really been wanting to get funded. Been learning since 2020 and struggling. I've tried everything. I can't stop spending and wasting money on prop firms. I'm broke now. Help. So obviously that is a tough message to read. And for anybody who maybe feels like that in the audience, but didn't have the, didn't want to put that into a forum or share that with us, I appreciate it to this person. who shared that with us. Look, you're not alone. A lot of people make that same mistake. And let me just get it out of the way right now. Prop firms do not mean, oh, yeah, it's just a harmless $200. That is really dangerous. If you're not ready to be trading someone else's money, substantial amounts of money, prop firms are a dangerous, deceiving thing. If you are not a profitable trader, you should not be touching them whatsoever, because just because, oh yeah, this challenge only costs me $300, that's not going to kill me. If I lose $300, it's better than losing my $5,000 in the market. Well, again, this person's message expresses, I think, the frustration that many traders have. They went down that rabbit hole thinking, oh, it's only $300, and then they do 50 different challenges, and they've run out, their payouts are nothing compared to what they're spending in challenges. And they're sitting there and saying, what have I done? I tricked myself into just going down the prop firm route when I wasn't ready for it. And I've lost a ton of money chasing prop firms. So if that's you in the audience, no judgment here, because that's a lot of people. A lot of people made that mistake. It's a very easy thing to go, take a challenge. Why would I don't need to load my own personal money into a brokerage account. Let me just do a challenge. Sounds good in theory, but if you are not personally ready to manage that kind of money, I think prop firms are a dangerous path to go down if you're not ready, if you're not actually consistently profitable. And we have one other question. Aaron says, I've been there, buddy, lost over 30K before getting consistent. But when you get back consistent, you make all your losses back in 2 years, in 1 to 2 years. Yeah. So, I mean, look, prop firms are not, by their very nature, they're not, in my opinion, a bad thing necessarily, but they are a terrible thing for people who are not already consistently profitable. Ivan, what would you think on that?
First of all, kudos for that person to say what they said. I have met some of these people, not that person particularly, but it's heartbreaking, it's heart-wrenching, and what I generally seems to find that there's still unprofitable traders that still has a lot to learn. And I say that prop firms is only for the most experienced. You're at your peak. It's kind of like the world championship in trading. You need to be at your absolute best to succeed to do it, because success rate is about 5% or so at the end of the day who gets actually funded. So it's a very narrow space to get into. But I mean, it's possible people in this community have done it before, but that also means that they have really perfected whatever they are doing. So as much as I feel very compassionate for this person, fixing the strategy and the trading has to be the first priority before even thinking about prop firm.
Yeah, and it's hard because, to that person or to anyone else who maybe feels like they're in that situation where they're like, dang, I mean, I'm in the hole a ton of money. I know that doesn't sound good to hear from Ivan and I, like, hey, you should probably not be trading anymore for a little while, or at least go to a demo account or really study this stuff. I know it doesn't sound good because you're like, I'm feeling the fresh effects of losing all this money. I want to get that back. That's a natural human response when you lose money, or you lose, for thousands of years, if you lose resources or goods or whatever, you want to get them back. You want to recover your losses. What is so dangerous about the trading space is that people go into bigger and bigger debt chasing their mistakes, not changing anything, just saying, well, this time it's going to be different for me. So I would really encourage you, if you're somebody who is struggling with that, if you're treating this like a lottery ticket and you feel like it feels like a lottery ticket, you're like, this time's going to be different. I'm going to load up and I'm going to, double my account. I'm going to get a big payout. Just be careful, because you can totally treat trading like a gambling problem. And it's dangerous because you can treat it like a gambling problem from the comfort of your home. Just like all these online sports casinos and things like that. You can bet sports. It is a real thing. You have to be careful with this stuff. This stuff can be addictive. This stuff can be treated like a game. I'm a big fan of asking yourself, is my trading boring? And if the answer is no, you're probably doing it wrong. Trading should be boring. In terms of the actual execution, watching your P&L, those things should be boring. Your percentage moves per month should not be exhilarating to you. And if they are, good or bad, like if you're like super thrilled when you're having an up day, or you're super depressed when you're having a down day, I'm telling you, if you want to do this for the next 20 years, you can't treat it like that. It has to be more boring than that. If every move is causing you to rush to your phone and check your P&L for the day, that is a sign that you've gamified your trading to the point that it's more like gambling than it is truly like a slow and steady kind of enhanced investment approach.
Yeah. And I think that person, or those, or any one of us, I guess, needs some inner work in terms of, I don't know, in terms of getting past the resentment that you have for trading, and that it has made you so much, that you have lost so much money on it, is unfortunately another way to burn your candle at both ends at the same time, because you need to be, again, top performer for yourself. You have to look into yourself at, am I able to, and can you prove it? And it's a whole other ball game with prop firms, with all these rules and regulations that, depending on which one you choose, makes you take away the possible to just hold a trade for a long time, where in some prop firms you have to end it by the end of the day. So it becomes a bit of a more and a different psychology than your normal psychology. So to be able to manage your emotions, be at your best, physically, mentally, and trading wise, it's that's a journey and a half. And it's not easy to just do that in one day.
Yep. Well said. Important stuff here today, guys. Ivan, we've got to move on to our next segment of the show, but I want to thank you for your input on these really important questions. And I think, those are the sort of conversations that I think really, hopefully for someone out there that really resonated, and they're like, whoa, that changed my perspective. Ivan and I have been doing this for a long time. We can both tell you till we're blue in the face that this stuff is really hard, and it's not an easy process, and you need to slow way down before you think you're going to, jump in and make a bunch of money in markets. Easy to say, very hard to do. So Ivan, thank you for sharing your wisdom with us here this morning. And before you go, everybody who would like to follow along with Ivan, his channel just got dropped by our producer in the link. So here's his link to his channel. You can also send him a direct message in our Discord chat. If you're a member of our Discord group, send him a message, ask him about his coaching services. He does one-on-one coaching. If that's something that would be beneficial to you, I highly recommend spending some time with Ivan and working through what you're working through in your trading. It will really help to have someone step along with you. So check him out, send him a message. Ivan, thanks for coming on the show.
Thank you very much for having me.
All right. See you, Ivan. Up next, guys, we have Chris Pulver joining the call. I'm going to stick around for just a minute with him and say hello. And then we will be right back with him just after this quick break.
Hey everybody, thanks for tuning in to today's A1 trading session. We love engaging with our audience, talking shop, taking requests, and sharing our favorite setups. It's about that time where we're going to review a bunch of indexes, stocks, currencies, gold, silver, Bitcoin, and pretty much anything else, and share our insights. If you're wondering what trades I'm in, if you're wondering what trades I'm taking, and you'd like to see exactly how I'm trading everything, you can actually follow my trading signals. If that sounds like something you're interested in, we'll share a link in the chat. You can sign up. You can sign up directly with the link or speak to a support rep if you have any questions. If you're asking, what do I trade? Pretty much everything. Indexes, ETFs, stocks, options, futures, Forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show.
All right. Good to see you, Chris. How you doing, man?
What's up, Nick? How are you, man?
I'm good. Chris has been, if you guys are just tuning in for the first time, not seen a session with Chris before, he's been on the show for quite some time with us, sharing insights on markets. And that being said, Chris, we haven't spoken in a minute, and I hope you're doing well, man. But I also wanted to ask you specifically about this recent rally. How much more juice do you think this thing has? I mean, we're almost back towards, believe it or not, back to those all-time highs. I'm pretty shocked by it. What are your thoughts?
Yeah, that's probably the likely destination. I mean, at this point, since we didn't really have much of a pullback after that U.S.-China trade agreement gap, I mean, yes, we pulled back to pretty much test it. We didn't fill it. Um, I am thinking that this market just wants to get to all-time highs. I think that disappointing to feel like there was very little opportunity to really participate with a technical pullback because
Mm.
even running into major resistance around all those moving averages around I'm talking SPX here, like 56, 5700 zone, that US China gap just kind of threw things higher. It's like at that point the bears just kind of gave up.
Yeah.
So all we've seen these last few weeks, it's like price really hasn't gone aggressively higher, but it's like every single day you can notice intraday price action is just trying to melt up, trying to melt up, trying to melt up. And sitting here watching where we're currently at just over 6,000, that was another kind of round number. Had a little resistance off it with the Musk and Trump drama last week.
Mm.
Markets don't seem to care. Um, I mean, I think just the easiest thing is going to be if we just melt up to the highs. Okay, fine. I still think a pullback is likely going to happen. I wouldn't be aggressive at all-time highs. I mean, that's just me. So thoughts on that, Nick? I mean, we could clearly go into a melt up, but there's still a lot of things the market's going to have to digest through the summer. This first kind of 90-day pause through tariffs that'd be in July. Powell, Trump is calling out Powell again for cutting rates, and if more stuff happens with Musk and Trump, who knows? But we don't know. I mean, how the negotiations are going for like global tariff conversations.
Mm.
U.S. data, it's all like the same uncertainty is still there. It's just the market just doesn't care anymore. Like right now, it just seems the market just doesn't care. So I'm not upset about watching new highs in the portfolio. I'm not. I'm just I saw some of the posts you had last week. I mean, how aggressive are you right now? At all? I mean, just kind of enjoying the melt up. Are you participating actively? I mean, I've tilted, so I mean, I'm seeing some fresh highs. I talked about this last week. If we go to all-time highs, I'm probably going to see like 275 to 280 in the portfolio, which is fine.
Mhm.
But I mean, so I've got some bigger plays. Like actually, uranium's been taking off quite a bit for me. Gold and silver are doing pretty well.
Nice.
Silver's had a nice run last week, so those little like holding trades for me are still like generating some juice. But
Yeah.
other than that, it's just kind of swing trading the indexes and trying to stay out of the way and let this melt up happen.
I'm kind of in the same camp. I've got a long position on the Russell right now, which has gone pretty
Okay.
well.
Yep.
IWM, so I'm long IWM. I've got a big basket of tech stocks that I picked up during the sell-off, so I've done pretty well on that side. I sold covered calls on several names that I have in the portfolio just with this move. I do think we're getting a little bit stretched, but where I see, to your point, Chris, about maybe just making that move back to the all-time high, what I think is fueling it, what I think gives it more juice, is sentiment is still convinced it's the other way, right? We've seen, looking at the investor sentiment surveys, we've seen persistent kind of negativity around markets. We're still above historical bearish averages at 41.4%.
Yep.
Then you take a look at the put to call ratio. Put to call ratio has been still on the upper end. Put demand is still very strong out there.
Mm-hmm.
And so, to me, Chris, I think, while I don't necessarily think that we take out all-time highs and then just it's a forever melt up, I think Trump kind of continues to introduce and keep that volatility somewhere in the back pocket all times.
Right.
I do think that this thing can continue to climb that wall of worry that is so clearly still the case for a lot of sentiment out there. One of the things about 2023, I know you did well in 2023, the bounce back after that big fallout year in 2022.
Mm-hmm.
The big bounce back year was, built on just this pessimism around we're going into a recession and all that. So, we may be seeing a repeat event of just climbing that negative sentiment despite the odds. I think what we have behind us now is like, okay, Trump seems to back down every time things get really real when it comes to tariffs.
Yep.
And I think the market takes that as okay, the Trump put is there. And, the Trump put is there. Fed probably wants to cut interest rates this year. Earnings came in pretty good and sentiment is still negative. I feel like that's a recipe for at least a retest of those highs.
I agree. The only potential like flaw of the next like month would be that there's a blackout window for buybacks in these next like 2 to 4 weeks. So that I mean, we had like record level buybacks this year, which I think was overall a boon for this little melt up. Like China and U.S. talked apparently last week. They're supposedly in London this week to talk more. So I mean, what we quickly learned after April 9th was this whole idea of tariffing the world is really about the U.S. just trying to rein in China. That's really what it is. And if the U.S. is trying to also get into the metal space or the refined metal space for AI infrastructure, I mean, the one thing that I keep looking at, Nick, is even though this is a melt up to all time highs, we're still way off these lows on Liberation Day yields. Global yields are rising. At some point, it's the rate of change that really shocks the market. So I mean, this like slow, consistent move up in yields is going to be a problem at some point. Like if 10-year yields are up to 5% and
Yeah.
crossing fresh highs, like that's a problem. That's where we start to see some of this this topping back in.
Yeah.
I was like a little
What are
pullback
your
in
thoughts on
2023.
TLT, Chris? Because I heard you. I
I
listened.
want
I
out
was
of it,
listening.
dude.
You're out
I
of it.
don't
Okay.
I don't want to hang on to it. I mean, I think
Okay.
that there is a lot of support down here, but honestly, if I had, I mean, I'm still in it, but I'm using a diagonal spread. My break even is like $85. And I'm just gonna actively kind of sell it, like because I'm out till 2027. I mean, I've got plenty of time in the trade, but for every 30 to 45 days, if I'm just selling calls again, it's a diagonal spread trade. So I've got a long dated call option. I'm just selling against it to lower the size of the debit. So I want out of it because I'd rather be in gold or silver or Bitcoin. That's kind of
No-
my whole allocation is like, never mind TLT. I don't want to be in it anymore. Give me the
Yeah.
diversification for gold, silver, Bitcoin. That to me is a better play than TLT.
I mean, Chris, so we can get just into the weeds for just a second. I don't want to. It's not the point of the show to get too political, but the whole Elon Musk and Donald Trump fallout did have me thinking this weekend. And to your, that's why I asked about TLT is, you know, politicians, it doesn't matter which way you lean, red or blue, right? In the United States, the challenge that I see and the long-term bull case that I'm a forever bull on gold on the big picture.
Yeah.
And I know you are too, right? The idea though that the national debt keeps climbing and there is no true incentive. In fact, there's strong disincentives. I don't know if that's a word, but opposite incentives to not cut spending. Like there is no way, and I think Elon Musk kind of had his meltdown and went to Twitter over realizing that he may have helped Trump get into the office, but it's not necessarily a Trump thing or a Biden thing or a red thing or a blue thing. It's just that the way Congress works, to keep seats in Congress, you have to administer to your sponsors. Your sponsors want you to keep spending money massively, frivolously. And it's a problem. The whole system is built on never ending government debt rising, spending more money, raise the national debt. It's concerning to me because I'm like, okay, do I really want to park a whole bunch of money in TLT? Well, the thing that I see, Chris, the challenge to all this is we have this national debt rising dramatically in a peacetime. What if we go into a wartime? We also have national debt rising dramatically. And the reason it hasn't blown up, I think, is because GDP growth has been pretty rock solid for the last few years, despite everything. What happens when we lose one of those two stories? What happens when we go into massive, well, hopefully never, but I don't really see this happening. But if we enter in some scary wartime environment and printing money like crazy happens,
Right.
or we lose the GDP statistics. Let's say that grind higher in the 10-year causes just national debt to become so unsustainable that we're using all of our GDP to pay. Like there is a scenario here where I'm like, if it all falls out, I don't want to be in TLT. I want to be in gold.
Correct. Yeah, and think about the scenario where, okay, so this administration when we first started was the first real accepted austerity that we've had in the US for a long time. Like when Trump got elected, it was about let's fix the government, right?
Yeah, right.
Get rid of
Right.
corruption. That's why we have Doge. And you can see the consensus. Like people were supporting the idea that Trump can Musk can come in and try. I mean, try to cut $2 trillion. That was the
Mhm.
plan. They cut a couple $100 billion. And then obviously there's been a huge disconnect now that Musk is like, look, call your congressman, call your senator, get this bill killed. Like this is terrible. It's just going to add. I mean, everybody knows it. Everyone knows it's going to add $2.4 trillion to the deficit. and again, red or blue, it doesn't matter, because you can go back historically and see for the last 70 years
They all do it.
that they've all added deficits. Like in fact, Republicans, believe it or not, everybody, Republicans are worse at adding to the deficit, because look, you've got socialism for the wealthy with the Republican Party. You've got socialism for the poor with Democrats. Democrats are not doing themselves any favor after losing this last election. I don't know if they're doing anything good to get votes back at all. But my point is, so we had supported austerity that quickly pivoted April 7th, right? Once we had Liberation Day on April 2nd, we had the dump on April 7th, and then April 9th was this big pivot. We went from austerity, crossed it off, that's not going to happen anymore, to now there's the Trump put, to now let's go to, we're going to grow our way out of it. We're going to grow our way through it. Nick, we're at 22 times earnings in the S&P. We can't really grow through it at perfect earnings right now. We can't grow through it at these all-time high valuations or these high valuations. So I think the third part of that is, okay, so we don't have austerity. We say we want to grow through it, but we really can't at these levels without having a better correction. We've got to grow from like a 14 times earnings, not a 22 times earnings.
Yeah.
And then the next thing that's left is print your way through it. More like add to the deficit, more money in the system, more liquidity,
which is always and
that's what we've always reverted to. That's all. Ultimately, we have been spending every year like we're in a COVID crisis or great financial crisis type situation. We're just throwing that in the markets.
Yeah.
And I do think that the US has kind of carried the world through COVID and into now. Now the other part of the world is catching up. So like Europe is spending more money, China's spending more money. And that's why you and I've talked about this, but like my bigger concern is like we just go into a global melt up, and the dumbest thing is that the market just keeps going higher, but ultimately it's still going to give back 30% or 40% or 50% at some point. You know,
Chris, the classic. Yeah, no, I agree with your senses there. I mean, that's the worry is that these resets need to almost happen. It's like breathe out, breathe in, and we've talked about this for years together about how the Fed saves every little dip, and well, I mean, I guess it wasn't really the big savior, I guess, in the recent sell off, but that was kind of a self-inflicted thing with the whole tariffs and then
totally
no
was.
tariffs.
The Fed was quiet, but that was all Trump, and that was all a Trump pivot. That was
Right.
all a Trump pivot. Yep.
And so, yeah, I mean, I think that's that is where I'm like, okay, I look at that and I say, this is why for traders, investors, most of the time we do these streams. Chris and I have collabed on these streams for a while. And most of the time it's kind of markets grinding higher, but then every once in a while you see how vicious the market can be when it turns down, when you get a VIX that spikes. And I think that we always talk about this, about how when you get to low VIXs, it's very simple, but you probably want to at least be considerate of, okay, another one of these is coming. Like another one of those is going to come at some point or the other. How are you going to deal, not when or not if, but when that happens again? And, Chris, you and I was talking about this earlier on the stream about kind of our situation that we went through in August of last year, and how August for me absolutely was so painful because I gave back so much of my gains due to some really bad slippage on that one. I think it was August 5th.
It was a weekend. It was the SOM rule. So Thursday, Friday, Monday, because that huge, like futures opened way lower on Sunday and they just bled all Sunday night. And then coming into Monday's open, it was like a 3 to 4% gap lower. And there was, the liquidity was brutal on that day.
And so I was trading the Qs on that day. So of course I didn't get the futures. I couldn't close out of anything in the futures. I was trading Qs. So Qs open up, boom, get stopped out, and market, bounces back. Really painful. But my point is just, for audience listeners, just be considerate when I think the VIX should be on everybody's chart, to be honest, or your watch list. I think everybody should look at the VIX and just say, hey, where are we at? Okay, we're in a relatively calm environment right now. How do I want to just be aware, be present currently, and say, okay, I know I'm not going to stay oblivious to the fact that this won't be here forever. It's going to go back up at some point. It may stay here for a couple of weeks, couple months.
Right.
But how are you just going to be positioned? And I just think that's something we should always be thinking about. It's something I always do think about. But there are those things that I just got done talking to you about, the sentiment stuff, kind of still remaining a little bit cautious. That tells me I think we may have a little bit of room for this to kind of keep squeezing. But we're also coming up, Chris, to the end of those 90-day pause timelines.
I think that's probably the market's next big window is, okay, so let's see, and here's how simple it could be. We get to 90 days, and what's the US going to do? probably just extend it another 90 days. I mean, I'm not
Hey,
serious.
that's
It's
how
like
they do the national debt. Why
this,
not?
it shows this
Yeah.
whole thing was just not planned out at all. It's like we'll go 90 days and give time to negotiate, and then we'll get to that 90 days. We'll say, well, we'll go another 90 days. We did with China already twice, so I don't see it being like a huge dramatic event. But I mean, look, I think right now it's like the whole market just wants Trump to keep his mouth shut, because if he just steps in and blasts Powell more, look, Powell is watching inflation probably more than anything else. This week we have CPI data, PPI data Wednesday, Thursday. The year over year in the headline CPI is expected to go higher, Nick. We printed 2.3 last month
2.5,
for
I
the
think,
year over
right?
year. Now it's projected 2.5. So we're looking at a 0.2 increase. Does the market take that as a bad thing? I don't think so. I mean, it's like the market earnings were solid, buybacks were at record highs. You know, Mag 7 was one of the one of the more aggressively rotated out of baskets to rotated right back into it. I think we clearly need Mag 7. We clearly need, you know, a broader market. But I mean, what's leading this year, and this is why I'm not super bullish on these markets right now. It's like what's leading are not typically bullish sectors. What's
Yeah.
leading us are utilities, industrials, financials. Those are not tech. Like that's not tech. I mean, we are a service and tech-based economy, and none of those sectors are leading. And if the argument is, well, it's because we're building out for AI. Well, I don't think we can handle AI. Right now, I don't think we have the infrastructure to handle AI. I don't think that we can handle the displacement if AI truly comes. I mean, you probably saw this in the headlines in the last 30 days. I don't remember the name, but somebody that's high up in the AI space is talking about in like a 1 to 10-year window, which is a big gap, obviously, but AI could come for 90+% of jobs.
Yeah.
And the governments aren't ready for that. And in corporate, like, I was having this conversation this weekend, but I don't know what the solution is. If all of a sudden 90% of jobs are replaced by AI, I mean, what do? You're going to have to tax the wealthiest companies that are making 90+% profit margins. You're going to have to tax them an insane amount, like almost as if like they're not going to be profitable because the government's going to have to tax them 50, 60, 70% in order to make up for the workers that are no longer working. You know, like,
Yeah.
is that where we're going? I don't know. And that's like so like rabbit hole negative. It sounds awful, but
Yeah.
it seems like we're at this point of like an adapt or die from a human standpoint and from a corporate standpoint. And AI sounds great, but it's like it's the only exciting thing that like Wall Street's grabbing onto. It's like this AI story because it could be so profitable. But if you displace a bunch of workers, and what's always been, everyone's worried about a recession. What's the biggest factor to cause these recessions, Nick?
Unemployment.
Exactly. So what happens when AI is the thing that's taking over, and all of a sudden our unemployment jumps from 4.2 to 6, 7, 8, 10%? We have a recession. And that is going to be felt in the markets, and consumption is going to drop because we're still 70+% GDP, or 70% of GDP is consumption. And
Yeah.
if you have the wealthiest individuals cutting back on spending, that's going to be the trickle down into everyone's going to feel it. So
Yeah.
ultimately, if people keep jobs, the recession can keep humming along. But if we see just a monster uptick, and again, it's like, is this all like self-fulfilling? We want AI, we built to AI. It's an arms race, and everyone's spending as much as they can to have a leg up in AI. But ultimately, what's it do? Just puts a bunch of people out of work, and the country goes in recession anyway. It's like there's no real great solution. It's like either way, something corrective or crisis wise is probably happening. I mean, it's just a typical bear market cycle. I mean, every 2 to 4 years, every 4 to 10 years, like you have these windows. We haven't had a horrible market since 2008. COVID
Yeah.
was fixed, and 2022 was a really more of a bond market collapse than it was an equities collapse, but everything was down. And then this year was like a tantrum. This was like I thought it was more systemic. I mean, if you saw the way that price action played out during like April 2nd, 3rd, 5th to the 7th, that felt like very systemic, that like all these countries and all this whole fiat system is tied together.
Yeah.
That was really eye-opening. So that's why I wanted to pivot harder into gold and into silver and into Bitcoin, simply because look, I don't think we can have a trustful bond market if nobody wants to really flood the markets with our safety net. Or it's just the only reason our stock market goes up is because there's more money supply, and you're just breaking even, like debasing the currency, money supply, and our stock market goes higher. Meanwhile, if you price in the SPX to gold, it's down. Like gold is stronger than the SPX performance wise. You price it in with the Nasdaq, it's down. You price it in with Bitcoin, it's like those assets are continuing to go up over time, I think those are good to have in the portfolio. So
Yeah.
anyway, I mean, the nice thing is with the U.S. markets with options, you can still generate a lot of income. I am way behind on some of these price appreciation moves. I mean, example, so IWM, I'm still selling calls with a 200 strike, and
Yeah.
IWM is trading at 211 or whatever it is right now. So
Yeah.
but what I'm doing is I can still roll. It's traded at 213, so I'm basically losing $1,300 of appreciation. But because I'm selling calls every couple of weeks and grabbing 150 to $200, after a month I make up for that gap if price doesn't continue to go sky high.
Yeah.
Tesla, I'm in the same thing. MicroStrategy, same thing. SPY, same thing. And it's certainly not the sexiest way to make income, but it is pretty consistent. And as long as I can keep going out 1 or 2 weeks, 1 or 2 weeks, 1 or 2 weeks,
Well,
I'll
and you'll
just keep
get that,
making money, dude.
most likely you'll get that kind of wave down, and that will
For
kind of
sure. And
reset
even
you
like
back
Tesla
to.
last week, like I went from a rolled covered call in Tesla to that big drop,
Oh
and I
yeah, I'm
was
sure
up
you did.
like
Yeah,
60% of my max profit on the covered
you
call
did well with
within
that.
like a week. So
Yeah, I've got
it's fine.
covered calls on Hood going on right now that I've been,
Oh yeah.
that kind of saved me a little bit. The S&P 500 did not accept Hood into it, so they,
Oh, they
I
didn't.
they did not, and
Interesting. Okay.
so I own the stock. I've got good gains on the stock, but I've been selling calls against it. Got
Yep.
a strike price of 75, expiring in 4 days. So this
Okay.
little drop back helps me out a good bit. I'm probably going to roll that up to 85 or 90 a
Nice.
month out, and just do what you're doing. Kind of just play that theta decay. If it goes sideways for a month, I'll be nicely in the green. So
Yeah.
on the trade and on the underlying position. So Chris,
Very
I'm
cool.
gonna run. I'm gonna let you take 20-25 minutes, go solo, just
Sure.
get through whatever you'd like to go through. I've been on since 9 a.m. So I'm gonna go take a break, grab some water. Thanks for taking over the show. If anybody would like access to the pulver alerts, just a heads up, those two are also 45% off right now. If you would like to get trade notifications from myself and or Chris, send us a direct message on our website right now. We'll drop the link to where you can speak to our support team. Boom, there it is. Click a link there. Send us a direct message. Let us know you'd like to join VIP. Chris, you got it from here, man. Nice speaking
All
with
right.
you.
Thanks, Nick. Thanks for hanging out.
See you, man.
See you, dude. All right, I was just looking at Robinhood. So Robinhood's had a big run, similar to Palantir. I just saw some comparisons. So I do think this is interesting. So weekly overbought conditions with some divergence, maybe some volatility had on Robinhood. One thing that'd be pretty exciting would be if we break these highs. This is a comparison I saw. I don't think this is really going to happen. It's two very different spaces. But Palantir, when we broke these highs, just didn't look back at all. So Palantir was up 196% higher than the all-time highs. And so now the question is, well, if we did that on Robinhood, is that a thing? Could we break these highs around $85 on Robinhood, and could we go up another 196%? Well, like I said, I think it's in two very different spaces. But I mean, just imagine the surge of $200+ a share on Robinhood. Look, I think that trading is in a very good place. I continue to see that option volume is just growing. If you look at option volume since 2020, your kind of standard like option volume, and then 2020, and now it's just option volume is so big every single day. 50 to 55% of daily transaction is all zero DTE. Um, and obviously there's a mix of traders, there's a mix of gamblers. Zero DTE, just so you know, there is about 10 times more risk in zero DTE. And it's just because of the gamma. All that is like how sensitive pricing can be in options, and how much quicker prices move in your favor or against you. So it's 10 times not really 10 times the risk, it's more 10 times the leverage. But as you know, leverage can work for and against you. Look, I do excuse me. I do a lot of trading every single day. So zero DT is something I've built strategies around. They were core strategies of mine over 40 to 60-day windows, and now I'm taking them down into 0 and 1 day options. And it's still mechanically the same thing. I just get a lot more reps now. So rather than taking 6 to 10 trades a year, I take 200+ trades a year, and potentially have the same reward to risk. So as long as I make sure that my net result is positive, it still works out the same way. I'm paying a lot more in commissions and fees, but fortunately that fee structure for me is not bad. So anyway, long story short is I still think it's a great time to be a trader. I think you're silly to not have protection in your portfolio at this point. As Nick and I were mentioning, I don't think the market is going to get. I mean, I guess the question is like, what or why? Like, what or why would be the reason the market would drop? I mean, you could rattle off a ton of reasons that have been known since April. It's the same myriad of reasons of why this market could turn and fall. Okay, the market doesn't seem to care. Now, technically speaking, I mean, we can zoom in a little bit, um, and I just think this is something to watch, right? So a lot of moving averages, still some pretty good support. I mean, 1 hour trend lines look really, really solid to the upside. The market keeps melting up. I would be watching this, however. Okay, watch this connected lows. You just go from this low right here, right before the U.S.-China trade agreement gap. You can start with these lows, connect the dots. Okay. So if you look from where I connect these levels, you have this low here, this low here, this low here, this low here. So we've had responses to that trend line. Okay. So let's go to these recent highs. Well, if this market decides to just keep melting up higher, 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 can we just connect the dots up here as well? You know, to me, this is a pattern. This is a rising wedge. We have all-time highs sitting right here. Is it possible that we just go chop, 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 poke the all-time highs, and then fade? The one thing that's missing right now from price is that the bears have not taken out any recent lows, right? So as bearish and as cautious as I might be, I'm not bearish rather, but as cautious as I might be, we're not taking out lows, we're not taking out lows, we're not taking out lows. So even though this pullback to me makes a lot of sense, it's not happening yet, right? So it doesn't do me any good to be positioning for a pullback that price is not supporting right now. So all I'm really doing is I'm being patient. I'm still sitting with a lot of cash. I mean, I'm at one. I mean, I'm still around 50% of my portfolio is cash. Now, I've talked about this before. This is what I'm going to do with it. Um, I'm still in, so I've put in some more like core ownership positions. I've gone bigger in Bitcoin. I've gone bigger in gold and silver. Uranium's been a nice little play. I've been in there for the last couple of years. It's starting to take off with this whole shift into like more of a nuclear adoption, like nuclear energy adoption. So URA is doing pretty well. But I'm not chasing really anything. I mean, stocks are up, cool. Indexes are up, cool. Like I'm not chasing, right? What I'm doing is now that I've established some core positions, I'm using options to generate some income. It's boring, but across the board here, I'm just trying. I'm doing the math here. I would say that across the board, if I do, let me just write my list out here. So the core positions that I'm routinely adding covered calls to, I have SPY, IWM, MicroStrategy. What else? Tesla. That's kind of it. I remove my covered calls on SLV, so that's running like it's just running with no covered calls, so it could be all price appreciation. I think silver has room to take off. Um, I'm still exposed long on gold and silver with no covered calls. Trying to think anything else. That's kind of the big core ones there. So on average, and I'll put this, I'm on like basically 13 accounts. Okay, so 13 accounts all have these core positions. On the SPY, if I can generate about $1 a week, so $100 a week times 13 accounts. Okay, so that's about $1,300 every probably 1 to 2 weeks. I'll be conservative here. I'll just say every couple of weeks. Okay, so $1,300 every 2 weeks. Okay, IWM is a little bit less premium, but I'm getting about $100 every 4 weeks. So I'll say $100. I want to kind of make these out like monthly income. So we'll go $100 every week, 1 week. IWM about $100 every 2 weeks. Okay, MicroStrategy is a lot more lucrative. I can get typically like $250. That's on a low end, upwards of like $5, $250 every 2 weeks. And on Tesla, probably about $200 every 2 weeks. Okay, so I'll just add this up. I might as well just space out this and say $200 for every 2 weeks. So I've got $200 on the SPY, $100 on the IWM, $250 on MicroStrategy, $200 on Tesla is 2, 3, 4, 5, 750, right? So equals $750 times 13 accounts equals Okay, so every couple of weeks, my portfolio just on these core positions alone can generate about $9,700. Okay, so if I do this over a month, I can generate on my portfolio about $19,500 every month. Now, that is if I want to keep the positions and keep them running and keep rolling these calls over and over again. I do think that a pullback eventually will that price. So if my Tesla cover calls at 277.50 and price drops to 250, well, at some point that's like, well, now I'm upside down. Even though I've lowered my cost basis on Tesla down to 240, I'm still in profit on the trade, but I'm just going to keep selling calls. Eventually, I've got to be careful on how much lower I go with my call price because I'll start chewing into some of those profits. But just on sheer option income, this is helping me make some money. This is why my portfolio is up another $17,000 from my recent high. I told traders that if we get to all-time highs, the tilt in my portfolio probably gets me up to like 275 to 280. That's fine. And in the background, uranium's taken off nicely. I'm not in a huge position there, but it's enough to notice. Silver's taken off nicely. That's a big enough position that it is enough to notice. So if I go to uranium, for example, it's up around $11,000. If I go to silver, which I have mostly, there's 3 positions I'm in silver. There is CEF, which is a gold and silver ETF, and CEF is up around $4,700. There's PHYS, which is up around $4,000, and then there's of course SLV, which is up around $29,000. So silver's a pretty good chunk of profit, and I'm not touching it. I'm not going to sell calls. I'm not getting in the way. I think silver has room to run. Meanwhile, these are decent enough premiums to maintain a core position, generate income on. This is a client account that I received about 3 weeks ago. Okay, already up about $2,500 the last couple of weeks by doing something very boring. And I don't care if I did this all year, and this account can generate, let's say, 30 to 40 grand without taking a ton of risk and just selling calls and using the capital as an income-based method to just keep collecting income. So I'm in a stage right now where it's like this year to me is I want to protect the downside and make sure that I'm not overexposed. Okay. I was pretty aggressive in here, as I think a lot of well, I'm not going to say I'm a smart trader. Okay. I understand the opportunity when it was presented. I saw the technicals of a previous all-time high getting tested. And I mean, I bought the SPY at 96. That's a pretty good spot. I bought the Qs at 410. That's a pretty good spot. I am not holding them. Okay. Even though I bought the SPY at 496, we had lows at 482. So I bought in like pretty close to the lows. I did not hold these things back up to 599. When we got back to this level here around 570, I started to dump my shares. I thought this was a lot of past support becoming resistance. I thought we just got above the 200 moving average on the daily time frame. That's going to run some resistance. I dumped the shares. The US-China trade gap kind of made me mad just because it was a 3 to 4% gap, and here we are just kind of floating higher. It's fine. I mean, so what am I doing? Well, I sold a chunk of the shares, but what I am keeping, I'm just selling calls against. And my calls are like, I've got a 585 and I've got a 590. And I'm just selling calls. I get it that price is going up higher, but if I can generate income on it, I will. Okay. So anyway, long story short is what I'm doing right now is not super exciting, but it is consistently generating income. And that's enough to move the needle right now, because what I have is I've got lots of cash at the ready for a pullback. And I do think a pullback inevitably is going to happen. So whether we, grind to all-time highs, I mean, just think about where the pain of the market has been. And we've mentioned this many times during the last couple of months. The pain for traders and investors, and really the pain for institutions right now, is missing out, right? So what's happening in the backgrounds here? Well, retail traders were really smart money in this case because they've just been conditioned for 15 years. If you buy the dip or things get bad enough, the government steps in, the Fed steps in, and things get fixed, you just buy and hold. You add more, you dollar cost average in, right? And the retail trader looks way smarter than what I think the institutions give them credit for. Granted, the retail trader is way riskier, and the retail trader is terrible at managing risk. But if ultimately the markets are going to go up and go up again and go up again, what institutions are doing is not participating in this at all. And what they've done is they've held here, they weathered this, they're holding here. And I think at this point, I'm curious, like, are they going to add anything that's on the sidelines? Because I feel like they're not going to. We have $7+ trillion in money market funds. I really think it'd be a terrible decision to see $7 trillion come out and say, well, the alternative is put you back into the equities market. At this level, this would be the last spot that I want to buy. I mean, if you look at this from a trader's perspective, this high, I don't want to buy that high. I'm hoping that this market from this level at least responds to some type of pullback. That's it. Seasonality wise, we know this typically happens. You look at your edge finder seasonality, you can see that, typically August, September are pullback months. These window pockets we have, this whole refi pocket we have in the US from like September onwards, these are risks that are still going to be 2025 risks. The Fed at financing rates. I mean, the Fed starts cutting this September. How aggressive do they cut? If they cut at all, I guess we'll find out. I mean, if we see inflation going higher, I think that at this point, it's pretty safe to say that Trump doesn't want Powell to be Fed chair anymore. And coming into 2026, we're going to have a new Fed chair. Jerome Powell's done in May of next year. So whoever that is, it's probably going to be somebody that's going to be willing to cut rates, willing to listen to the president, willing to honestly blur the lines of having an independent Fed to a more of a kind of politically tied Fed. And I don't know if that's a good or bad thing. But I mean, what we don't want to see is we don't want to see higher inflation. Nobody wants to experience or see higher inflation. It's like the hidden tax that's really pissed off everybody for the last 5 years. So if we get to these all-time highs, fine. Technically speaking, I hope there's a pullback because there's still a lot of technical reasons. I still would look at this entire position and say, best case scenario is that we hit highs and we have some sideways movement and it offers buyers a chance to say, I'm going to participate in this, and the data looks better to support it. We go to higher highs. Okay. I think a realistic play is that the market gets to these highs, pulls back, and just finds some dips, right? Find this like this is a ridiculously strong support level. Now that the bulls have just like shown, hey, look, we're in control. The bears are absent. I just think that this is a great spot to offer a dip if we get it. And I don't know what the catalyst is to turn it that way. That's the downside. We just don't have like a normal, like, well, the market's just going to pull back. Well, we can't have that, right? Instead, it's like, why is the market down 1%? Why is it down another 3, 4, 5%? It's going to be a bunch of terrible things happening all at once, and the market's down really quickly. But ultimately, it's probably going to be fine. And what would be the trickiest environment would be we get up to these highs, we come all the way back down here, and everyone in retail is buying this dip, and everyone is just going to see another flush lower. And it's not necessarily breaking lows, but it's enough to get down here to these nasty April lows. And it's like, what the heck just happened, right? We just spent months recovering, and here we are giving it all back. I think that would be the trickiest environment to trade. It'd be extremely difficult because everyone feels a lot better about the economy right now, right? Even though bears, and I'm still surprised that bear sentiment is that high. I don't know if who is surveyed here is just more like politically motivated to say like, I'm so bearish. I mean, look, I get it. There's a lot of uncertainty, but the economy is showing resiliency. Unemployment still historically low. And until those start to tick up, like this whole idea of having a recession, or at least having like a full on everybody feels a recession, I don't think is the case. I think certain sectors can feel it. I think the consumer can feel it. I think Main Street is feeling, recession-ish, and that's why sentiment is so bad. But Wall Street shows us price action wise is something very different. So I think that my plan is if we get pullbacks in here, I will be taking option trades that allow me to stay out of the way. I can still make money in this environment here. If prices go back up again, cool, I'll participate. If prices stay sideways again, and maybe we have a range level or like a higher low but lower highs, I don't know. I will say this: if the market goes and just melts up, if we're at 650, if we're at 650 SPY to 700 SPY, depending on how that looks, I've got to be ready for some type of correction. Even if we pull back here again, we're going to have a correction. And my concern is that it becomes that type of correction. That to me is a bigger concern, right? Is that we hit these levels, we connect these dots, and it's just a classic broadening pattern, but nobody's really ready for the market to make Okay, so we went here, we pulled back, we went here, we pulled back, we go up here again. Everyone's all excited, but then we pull back if we make a fresh low, right? It's just bull traps and bear traps. So we did that in 2018, 19, 20, 21 to 22. Like that was how this market played out for almost 4 years. And once we got through the bear market 2022 up to some highs, and it kind of blew through that pattern. But it does have the ability to kind of set the framework of like pain excuse me, painful trades up or down, you know? So I'm not overcommitted to the upside. I think this market is very determined to get to the upside. I think if you're going to have a bias right now, it just has to be conservative, but like hinted or slightly tilted towards the bullish trade. Once we get to these highs, then okay, what's next? You know, is it just all positive news? Like I said, there's going to be a blackout window for buybacks. Maybe that pauses the market a little bit after this earnings season. We get into this, you know, there's going to be a brief holiday window through July. Then there's the 90-day pause. What's the result of like having this first 90-day tariff, this tariff window pause? I don't know. Maybe we kick it down the road another 90 days. Does the market like that or hate that? I don't know. I mean, I think the market won't mind because all it shows is we're still just trying to negotiate with countries. But it just depends on how it's rolled out, you know? So, I don't know. I mean, honestly, the last couple weeks, I've just grown a little bit more frustrated with like, yeah, I get it. Like, I'm just gonna have the markets benefit from, or I'll benefit if the markets higher. That's fine. But I don't feel a lot of conviction at participating at fresh highs. You know, I'm same thing. And again, call me, I guess, call me overly patient, but I still think there's a reason I'm gonna wait for gold to pull back. Right? I mean, one thing that would be I think a great trade in gold, and Nick talked about this earlier in the year, is maybe something that gets me back to the correction that I want. I want this correction back down to the 144 200 moving average in gold. We're now stretched over 400 bars. If we end up breaking here in gold and going higher, we'll have a little bit of an asset bubble here in gold. It might run to 3,800, might run to 4,000. I think from that point, something's going to be like the bond market breaks, the dollar breaks, something happens where it's going to be like wild and crazy moves. Everyone's going to be excited up here, only to face a really nasty correction coming later. You know, so gold just kind of staying sideways, it's actually a good thing because to me, this is just a healthy bull market that's showing consolidation and it allows bulls to still accumulate here. And once we go higher, great. It's a healthy bull market. The one thing I didn't want to see was what everyone was like bullish gold. It's like once you're here and it's just stretching further and further and further away, give me a chart. Okay? Give me a chart that's stretched away from all these moving averages and that keeps going without eventually crashing. There's not a chart that just keeps going and going and going and going. There's not. So this is a good thing. So for everyone that's just impatient now with gold because it's going sideways, it's okay. Wait it out. This market will give us an opportunity to one, either consolidate and let these averages catch up and we can accumulate some more here and then we'll see a nice healthy run higher. Meanwhile, we've seen silver take off, right? Silver compared to gold is working way better, right? Silver is way better right now and I love it. And I have been saying this. I am liking silver better than gold from a technical standpoint. It is a lot cheaper to trade. I can measure my highs. I can measure my swing trades. I can measure my symmetries. And I mean, I could see silver going to, $40 and change, $41 and change. And honestly, all-time highs are all the way up to $48 to $49. Okay. So if I said nothing other than look, silver has room to run another 30% higher, I'm pretty excited about that trade. If silver pulls back, knowing that this is a potential target, look, a pullback into this level here, a pullback into this level here would all be dynamically supported. So if it just stays in a trend and we make higher lows and higher lows and higher lows and higher lows and higher lows, if we're making higher lows and higher highs, that's a trend. There's a lot of ways to participate in this market. Okay. So I still think silver is great. Bitcoin pulled back briefly. We pulled back into this first little inefficiency around lows at 100,000. Bitcoin is probably going to perform well. Like I thought we'd have like an opportunistic pullback in here, thinking we could pull back maybe to like 98. Didn't quite get there yet. The question is this it? Is this an overbought condition with divergence that pulls back from, highs at 112 back to 100? It's a little tiny pullback, right? That is about a 10% correction. Okay. Is that it? 10% correction on Bitcoin and we're going to all-time highs again? Maybe. Okay, we'll find out. But I think it's more unlikely that Bitcoin comes all the way back to these lows. Unless the market's going to have an aggressive pullback, I think that Bitcoin is just going to keep offering really this alternative that is getting better and better every single day. I think there's more and more compelling conviction behind Bitcoin. I think there's more mainstream adoption of Bitcoin. There's obviously more securitization of Bitcoin. When you look, if you have a retirement portfolio and you can now allocate 1% of Bitcoin, you can allocate 3 to 5%. You can choose whatever you want, obviously. But even for most of financial advisors to offer some type of Bitcoin exposure, I think that's a good thing. I really do. And what does this represent? Bitcoin represents the potential hedge against the entire fiat system. And I think in 2025, that's probably as obvious of a trade as I could imagine in the last, 6, 7, 8 years when it was like being discussed is, if the fiat system, it's a big Ponzi scheme and blah, blah. True. But what we're seeing with the manipulation in the bond market and the dollar being down, it's 9%. The dollar itself is down 9%. Worst start since 1990. Okay. If all we're going to do is we say austerity, but it's not austerity. We say growth, but it's not real growth. We print. Hedging that system is Bitcoin, in my opinion. And I'm not saying that Bitcoin is immune. I'm not saying that it doesn't have any problems. It's going to have volatility. We're going to have some pullbacks. Obviously, there could be all sorts of weird competition where it's like, the not your crypto, not your keys, or not your keys, not your cheese type thing. Like, I get it. There's protective ways you want to make sure like you don't have your money touched or your Bitcoin touched, and that's a whole nother conversation. But I think it's a hedge from a system that probably is going to have to run parallel. I think if Bitcoin can offer a appreciating savings account while your checking account can be the indexes, your checking account can be the fiat system that's just meant to be printed and funded, and it's like the world is greased by dollars, but the world can be appreciating from something like gold and Bitcoin and other assets that are just not you can't print to oblivion. You can't keep the 21 million Bitcoin in circulation. That's it. Like once we hit 21 million, that's it. I hope. But instead it's going to be, okay, if we got 21 million, they got Bitcoin and they got layers and layers and layers of Bitcoin, because that's what the system is, right? You've got, I think global assets, if I'm not mistaken, is like $100 trillion in total global assets. But there's like $400 to $500 trillion worth of derivatives and leverage. And that's a lot, that's a lot of leverage that at some point goes away, at some point comes crashing down. But that's all the doom and gloom stuff that I'm not going to sit here and predict. I think that if you are a perma bear, or how easy it is to get caught up in the hype of how scary things are, you're just making terrible decisions and sticking your head in the sand and hoping that the market, if you're trading to be a bear, you're an idiot, because all this market has done for the last 70 years has gone through up, everything has gone up. It pulls back. Yes, it has corrections, but this is the most resilient instrument I have ever seen is the S&P 500. Like, this market has gone up through everything. And this is no different, right? Self-inflicted trade war in recessions, quantitative easing, tightening, war. It's like it just somehow the markets don't care. What the market ultimately cares about is, are companies making money? Are they making more money? Are they positive, optimistic about the future? And if so, and if interest rates are able to allow companies to grow, then things go higher. We could have the lost decade. 2000 to 2009 was a lost decade, essentially. If you looked at the dot-com bubble, it was a ridiculous melt up into the 2000 crash. And then it came all the way back down, spent years and years and years getting back to highs, came all the way back down, and then ended up breaking out. It took about 13 to 14 years to get through that window. But it wasn't like you didn't have opportunities. Individual stocks were like non-existent. You had stocks that went belly up and were delisted, but you had indexes that just survived. And yeah, you had a 50+% pullback, but the market is what? Hundreds and hundreds and hundreds and hundreds and hundreds of percent higher from that 2009. 2009's low to the 2000 to 2008 high. We're way above that now. So anyway, I don't know. You just can't be you can't be cynical, man. You can't be cynical. You can't be like I can be skeptical all day long, but I realize that the game that I'm playing is, for the most part, you got to stay bullish. You got to be bullish. You've got to have protection, and I'm willing to pay that extra, 1, 2, 3% a year in sacrificing some of my upside in order to make sure that I don't blow anything up on the downside. Okay, because also there is never a guarantee that this market has to stop at a said percent. Oh, the market pulled back 10%, buy the dip. It can go back 20, it can go 30, it can go 40, it can go 50. Like that's the scary part, is how bad does it get? And I think that's where the retail crowd is going to feel like they got burnt the worst. Is, let's say the market does hit these highs, right? And then the market does pull back to these levels I'm talking about. It pulls back right here. Well, look, I want to take some positions here. But you know what? You want to know what's scary? It's the same thing that was scary right here. It wasn't the first pullback that scared everybody. It was this. It was that next leg lower. So if we went from a high, low, lower, high, lower, low, that's where it gets worse, right? If we had another move like that, where it's like that second wave and I guess it'd be that third wave, fifth wave, that's when the retail crowd they go all in here and then just sit in a drawdown. They go all in here and they sit in a drawdown. That's where it gets really painful, right? And so if you think about the pain trade this year, retail's been rewarded really, really well. A lot of them recovered. Passive investors are essentially sitting here saying, hey, look, the market's up this year. Financial advisors haven't had to do anything. If you just sat tight and just said, look, this is noise, we'll get through it. Where you at? Well, you're up a couple percent this year. Your 60-40 portfolio is kind of garbage. I did this. We did it in this session, right? Did I not take like $100,000 portfolio? And I said, look, if I did SPY, QQQ, gold, silver, Bitcoin, I mean, it was up like 13 or 14%, while the S&P's up like 1, So there are ways to be just simply making money in these markets. But I want to have more downside protection just in case, And so if I can, squeak out 25 to 30+% gains this year, that's great. But I will be protecting a lot through the year. Like right now, I still have hedges into August, October, and December, just in case. We go into the volatility index. I don't think that I think we could all agree here. There's no way that volatility is going to be this way for the rest of the year. There's going to be something, right? There's going to be something. There's going to be something. There's going to be something. These are the scary times. Is it going to be that again? I would hope not. Okay, I think we know the agenda right now. But I mean, we could sit here and rattle off, I feel like 10 to 15 reasons on why the market could or should or will drop. Eventually, maybe that little perfect storm brews and it proves right. It could also be none of them. I mean, I still wonder. Okay, this big beautiful bill, is this going to get passed? Has Musk garnered up enough like noise in Twitter land that people are actually questioning what this big beautiful bill is all about? Or is it you can't stop Congress and House passes 215 to 214, Senate's going to pass it because it's majority Republican anyway? Maybe they do. And I think, look, senators want to stay in power and representatives want to stay in power. So what do? They pass this bill. Why? Because their fear is I won't keep my seat in the midterm in next November. So they'll vote to stay in their seat rather than vote for probably what is right. I don't think that adding $2.4 trillion to the deficit is good, right? That being said, it's like, is it an investment to actually grow to the point where, okay, if we add 2.4 trillion to the deficit, are we making $3, $4, $5 trillion in revenue? Maybe. And then maybe you can justify it. But we've never done that. We operate at a deficit, and the deficit just keeps staying consistently higher, like we have like crisis level spending. So anyway, I think that it's opened a lot of people's eyes to how quickly irresponsible the government really is. If you don't believe me, the U.S. government has pulled in over 60% more tax revenue in the last decade, and we've spent 90% of it, or 90% more. So we're still operating a deficit despite having higher tax revenues for the last decade. So we just like the economy is hooked like junkies. It's hooked on cheap money. It's hooked on spending. It's hooked on having debt in the system and having money supply grow. And I mean, at some point there's going to have to be like a great accounting reset, maybe some fiscal reset. Nothing's going to necessarily break. I really believe that. I don't think anything necessarily breaks. But ultimately, what is going to be stretched and stressed is going to have to get fixed. And nothing forces fix like a crisis. I mean, seriously, think about it. Like, if the markets right now just hum along to the upside, there's no crisis to fix. Why would the government pivot to austerity when we're right back up to, just a couple percent away from all-time highs? You know? And I mean, if the bond market, this would be the fix for the bond market. If the bond market has a type of move where, like right now, if the bond market just goes nowhere and it just goes sideways, 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 okay, fine. So bonds are stable. You collect your 3.9%, maybe lower the portfolio volatility. But if we have a falling, like breaking lows, this is a 4-year downturn in the bond market, and we still break those lows. I don't know what savvy investor is going to say, man, bonds are such a good, it's like they are a good deal, but what's going to cause this in the bond market? A bunch of risk off trading, So I don't know. I just don't want to be left being a bag holder with something that maybe breaks the lows. We've tested lows many times. There's no such thing as like triple and quadruple bottom. So unless this is a falling wedge in the bond market and this thing starts to take off higher, what makes that happen? Well, if global yields are rising, it's going to still suppress bond prices. So either global yields start to take a huge downturn, or we have a risk-off event that causes bonds to surge, and then yields can finally drop. And that's the bond market. But meanwhile, what's it do to equities? I don't know. Cause some more volatility. There's your spike in the VIX. Maybe it's a bond-related event. So it's a lot. It's a lot of guessing, and that's not trading. Okay. All I'm trying to do trading wise is safely generate income. Right now, my certainty is I know that I can keep selling covered calls. I can keep pruning my portfolio, taking my income plays as I see them, have a lot of cash at the ready because I want the opportunity. I want an opportunity to deploy that cash when I think it's good to buy something as opposed to chasing highs. Hood is up, Palantir's up, Carvana is up. It's like, yeah, I get it. That's not how I trade. I can make just as good of returns, safer with a lot less volatility by just trading a lot of options on some core positions, using my capital to invest and generate returns on that. But pretty diversified, honestly. I mean, between gold, silver, Bitcoin, I've got Japanese yen exposure, I've got uranium exposure, I trade the indexes, I trade some core positions. I'm pretty tight on a lot of stocks. I have some income trades with some scanners that I'm running right now. So, I mean, there's always something going on, but I mean, a lot of it's just a trade is a trade, and then understand your core strategies that help you make money. And what's kind of nice is even if the market goes to all-time highs, even if the market pulls back 5, 10, 15, 20%, I'm still going to be here trading, and I'll still be here doing my best to make some income. So anyway, all right, I think I'll wrap it up for my segment there. Platinum, no, I don't have any platinum. So Tasty doesn't do platinum on the futures market, so I'm not in platinum. Maybe doing like a if there's a platinum ETF. So platinum, so yeah, PL's platinum futures. Maybe this one, like physical platinum shares, so PPLT. Son of a biscuit. Well, never mind. Yeah, I mean, that would have been the trade. I mean, I've been staring at platinum for the last like 12 months, like realizing I like the support level. If you look at platinum futures, which is here, okay, platinum futures, I've got this yellow box. I'm like, yeah, this is a good spot to look to get long. And PPLT is right there. So, I mean, a buy-in, you had a chance to buy in like literally mid-April in the low 80s, and now it's up, $25. So at this point, I don't think I need to chase platinum. I think that this is also a rotation into, what has value that can actually keep it. Like platinum is an expensive metal, right? Gold is an expensive metal. Silver is more of an industrial metal, but gold and silver ratio is always pretty reliable. I trade palladium or coffee, or I mean, that's if you want to dabble in the future stuff, you got to get in those spaces. I'm not. My gold is oil, gold, silver, futures, and index futures. That's pretty much it. It's fine. I mean, I don't need to trade 20 different futures markets. I can, but I don't. So, but yeah, I missed it. Like the trade on platinum is gone. I mean, PPLT would have been the way I traded it, would have been in the low 80s. I looked at it to sell puts on PPLT. They just didn't offer anything. You know, if I look at puts on PPLT, okay, PPLT, try to trade this thing, go at 190 days, put in a strike here in the 80s. I mean, you see how this just dies off? Like if you're not selling like a 10 delta, it's like, okay, so I put in, I make $100 on an $85 instrument. So I put in an 80 or 85, an 85 strike. Well, if it comes back to me, then I can take some shares. Like I don't mind this, but I don't think that's, to me at this point, like it's not a good allocation of capital. I mean, if it runs, it runs, but you know, silver's running, gold is looking fine for consolidation. I don't need to chase. Right? Yeah, broader metals market, I agree. So the broader commodity market, the broader metals market is doing pretty well, and I think that's fine. But you know, also if you're like heavy in gold comes with like 25 to 50% drawdowns. You know, so be careful what you wish for. Thinking like gold is just this perfect instrument. It's not. Like it has periods where nothing happens. It has years of consolidation, but it also goes off and does pretty well too. Just had another trade close out for my scanner. Sweet. It's a nice little 50% winner. Okay, let me get that updated. So, all right, I'll let you go there. So I'll be back tomorrow. I'm not going to be on Wednesday. Unfortunately, I've got a conflict during my segment on Wednesday. But back tomorrow, Thursday, Friday for more of my segment here with A1 Trading. And let's just continue to grind this week. Just be mindful of this. We do have news on Wednesday, Thursday. Here is Wednesday's data. So core CPI year over year and headline CPI year over year. The one thing I'm watching the closest would be this. Year over year headline CPI. Previous was 2.3 and the forecast in 2.5. Okay, core CPI previous was 2.8. Now it's forecasted 2.9. So is this the market just saying like, yeah, it's fine. Inflation's fine. It's going higher, or is this like the market's not going to like it? Well, I don't know. We'll find out Wednesday. And also we have a PPI on Thursday. So watch those year over years. Okay, I'll let you go. Thanks for being with us today. We'll see you this week. Thanks. Bye.
Thanks again for watching today's show. Our goal at A1 Trading is to continue to share free value to our audience through daily videos and articles, keeping you up to date with the latest market coverage. If you enjoy our content, make sure to subscribe for more. From all of us at A1 Trading, have a great day, and we'll see you next time.